Macquarie Capital brings the intersection of expert advice, balance sheet, and creativity to our clients. We've helped clients grow and prosper over the years by making transformational acquisitions, and they've become our repeat clients for many years.
I think one of the really impressive things about Macquarie Capital is how nimble the division has been. We are able to position ourselves to address the areas of the market where there is growth. We focus on what we're good at.
We can do the traditional plain vanilla leverage buyout financings, but we can also do bespoke, smaller deals that are really structured to meet the client needs.
Benefits that Macquarie Capital brings to the community for our business include investing in high-growth technology and tech-enabled services businesses that are impacting the community on a daily basis.
My business area of expertise is real estate. If we're looking at a deal and we're looking at an equity opportunity, they can also come to us and say, we also need debt, and we can speak for the equity of the debt, and that's something that is our competitors can't do.
Our team in the US will often leverage and help support our colleagues in Europe and in Australia. So we're able to provide American acquisition opportunities or help our American buyers find European, Australian, Asian, and Latin American acquisition opportunities.
There's a lot of teams within Macquarie that cover different subsectors and different covered groups. And so I see a big opportunity to continue to collaborate with other groups internally in Americas, but also overseas.
My team focuses on US P3 infrastructure projects. Our area of expertise joins commercial expertise and financial expertise in project finance, but also technical expertise in terms of engineering and traffic to be able to deliver. It makes us a very credible and valuable partner to government entities, which we typically work with.
Here in Brazil, we are starting to develop Macquarie Capital. The economy is very large. It has a lot of opportunities of investment in infrastructure, in energy. I think Brazil and the rest of the region has a very important role to play in the energy transition. It has a lot of gaps also in infrastructure, basic infrastructure, social infrastructure. I think Macquarie Capital has a huge opportunity to create value and to make a difference, not only for the region, but also for the rest of the world.
Transportation has been looked at as a traditional sector over time, and I think now it'll start to adapt to changes in technology such as automated vehicles or the use of data for planning or for mass transit.
I think what we're seeing is software and technology bleeding into every industry in the world.
Macquarie Capital is reacting to the technological landscape today by, one, constantly investing in processes and tools that can help enhance our jobs as employees of Macquarie. Two, it's through investing in those, also leveraging best practices and reaching out to clients and serving them with the best needs that they can. And I think third is being able to invest in those high growth tools and technologies to be able to get better insight into what we are all doing too.
I really think that collaboration is one of the most differentiated things that we can bring to the table. We work across verticals. We break down silos. Because we are nimble,
Macquarie Capital has hired some of the best and brightest people that I've ever worked with.
My personal highlights during my time in Macquarie Capital includes the openness and mentorship that everyone provides, both senior and junior. It's the open culture where no one is being judged, every idea is accepted, and creativity is defined not by seniority, but by creativity alone.
I think the future is bright for Macquarie Capital. With some of the recent hires we've done across various industry sectors, it opens up a lot of new opportunities for clients in sectors we previously didn't cover.
There is a big, fragmented greenfield opportunity to grow our business. It's fun to be a part of a growing platform. And so I think there's just a lot of opportunity to get more clients, advise more folks on strategic decisions.
An exciting thing about the future of the business in the Americas, I think, is moving our headquarters to 665th. As a New York real estate investor for most of my career, I can tell you that, having a Fifth Avenue address, being on an avenue, having our logo on the top of the building will be a big deal.
But I just see the opportunity here, I guess the customer size, the market size, where Macquarie is today versus where it can be. I think there is so much opportunity for where we can grow.
So welcome to day 2 of the Investor Tour. We really appreciate you taking the time to visit our offices and to see what we've been building firsthand. And I hope you enjoyed the video from our team here, hearing why they joined and what keeps them here. Because at Macquarie Capital, it's all about our people and our culture. I'm also really pleased to welcome you to Macquarie's future regional headquarters here at 660 Fifth Avenue. We're going to move in here in 2024. Now, the timing is right for us in moving, securing new space for our growing footprint, and in doing so in a good leasing market. Now, we're excited about this unique space, which is being designed to bring people together and drive informal interactions across all of our teams. It's a feature you'd be very familiar with, having visited our offices in Sydney and other hub locations. And we're really happy with the building in terms of the construction that has been put together here. These windows are the biggest in New York in a commercial office building, 19 by 11, and it's been built in a way that actually is very environmentally responsible, putting a glass curtain on the outside rather than knocking it down and rebuilding it. So I hope you enjoy the views. We're also pretty excited and somewhat proud that we're now going to be clearly visible across Midtown Manhattan with the 3 Macquarie signs that are unmissable from Fifth Avenue, one of America's most iconic avenues. So today, our goal is to give you a sense of how Macquarie Capital is pursuing opportunities in the region. The size and potential of this market are what attracted me to this region in 2007 when I moved here from London, having started my career in Australia. And I've worked in a number of locations, but I've always had an eye to move to New York. Just to give you a sense of the scale of the opportunity here, within a square mile, there's around $10 trillion of PE AUM, private equity AUM. And there's about $10 trillion of AUM across all asset classes. And the size of that opportunity is why I've remained here in New York since becoming Global Group Head of MacCap in 2019. And it's also why my colleague Ben Way is also here now. So let me start by providing you with some global context. Across Macquarie Capital, we bring a solutions mindset, similar to the old merchant banks like Hill Samuel. Our mission at Macquarie is to connect ideas and capital for our clients and partners. They're at the centre of everything that we do. And we bring a perspective as both an advisor and a principal investor to all we do, to solve problems and drive solutions. But we don't try and do everything. We're trying to find areas where we can make a real-world impact. Now, our coverage teams, they talk to clients constantly to help them with advice, with access to capital markets, and to achieve their strategic priorities. And our equities teams provide specialised capabilities together with unique insights from research. And in addition to this, we bring our balance sheet to bear and deploy capital alongside our clients and partners. You'll hear more about all these areas today from leaders across MacCap in the region and how they come together for the benefit of our clients, partners, and people. And having been at Macquarie for over 25 years, I believe it's how we combine these solutions and capabilities that makes us unique. Before we go to the Americas, I want to provide a global perspective. We are a global business. You can see that evidenced by the principal book of over $20 billion across regions, and having deployed around $80 billion over the last 2 decades. However, global impact does not mean a single global approach. We recognise that each region requires a very specific strategy. To do that, we have specialist teams of 1,600 staff around the world on the ground, providing local insights and expertise. And whilst they're distributed globally, these teams work together because it's how we work together that creates the value for every region. We are a people business, and our people are our competitive advantage, and we empower them to own their own career and support them with it. It's an essential part of our culture. One such opportunity is mobility within the organisation. Just last year alone, 38 people within MacCap moved across regions globally, and 59 people moved in or outside of MacCap into other parts of the group. Now, turning to the Americas, we first entered this market in 1994, and we've since grown to around 400 staff across the region. Obviously, the US is the biggest market and has enormous potential for growth, but it's not the only story. It's not all about the US. We found very attractive opportunities across the Americas. For example, our presence in Canada is particularly important to our global coverage of critical minerals and energy. And we see a lot of opportunity in Latin America with our infrastructure team leading the way, already on the ground in Chile and Brazil, and with more opportunities to come. As I mentioned, in each region, we tailor our strategy. In the Americas, we've been focused on what makes us different in a competitive market. Now, this strategy requires conviction, with a patient eye to adjacencies and a willingness to change. Our key capabilities have changed over our 30 years in the region. For example, it was here that we first developed our sponsor finance business. And we continuously learn through our experiences, which in turn enable us to expand our capabilities, as you see on the slide. Our infrastructure development business is a great example of this. The same team who developed the Freeport LNG terminal in Texas, along with CGM, almost a decade ago, just led the development of our renewable natural gas platform, Aerogy, which John Pickhaver will outline a little later. We've expanded our sector coverage into adjacencies, such as the expansion into education and government services, which in many ways are natural adjacencies to infrastructure. Through all of this, there's been market volatility, as we all know, including recently, and I'm really proud of how our team has navigated it. But we also recognise that where we don't have an advantage, we place our bets accordingly. We don't cover many sectors in this region, many large sectors. A decade ago, we realised that our relevance to coverage of banks was not that relevant, so we pivoted to insurance and fintech, where we were getting a lot more traction. Or more recently, we've repositioned the equities business on narrow niches in region and doubled down on our roots in Asia Pacific. The fact is, not everything works, and we learn and we adapt our business accordingly. And that's why Macquarie Capital has always been the innovation engine within Macquarie. We see opportunities and we pursue them, but we're flexible enough to redirect our resources when our expectations are not met. And it's that entrepreneurial approach that has seen many businesses we created become meaningful standalone contributors to the group in their own right. From the original funds business that Shemara was part of in New York in the early 2000s, to the recent example of GIG moving to MAM. Now, whilst this can sometimes be hard, we're proud to do it, because it's why we're here to build businesses. And we will continue to evolve. Looking at the developments in the last 2 years alone, we can see many avenues for growth. So our past successes have excited us about the future here. In the largest capital market in the world, we have significant room to grow. The Americas accounts for over half the global fee wallet, which is $90 billion. And this is a market 25 times larger than the Australia-New Zealand market, where of course our market position is considerably different. So in this highly competitive market, we must take a differentiated approach. Here in this regard, we've had particular focus on financial sponsors, where we see a secular shift towards private capital. This is a trend we recognised early, building our business and our capabilities around private capital. And the trend has continued since. M&A in the PE market, volumes have grown at a 10% compound rate the last decade, and sponsors now account for 30% of all fee revenue in the Americas. We're also seeing these clients diversifying themselves from private equity into infrastructure or credit or real estate. And we can service and partner with them in these areas from within Macquarie Capital or the rest of the group. In the US, we also benefit from the tailwinds in infrastructure development like renewables that you heard about yesterday from Carl, Will, and others in the team. And the recent legislation like the Jobs Act and the IRA are already having a big impact, creating investment opportunities for both us and our clients. And these are big numbers. We're talking about $1 trillion unlocked of new investment. And we expect that that could create up to 9 million new jobs. The scale of the US and America's market opportunity is just conceptually huge and unconstrained. And you can see why we're excited. But to continue to grow profitably in this region, we have to maintain our discipline. This is why the fundamental focus in this region is depth of coverage and knowledge rather than breadth. What this translates to is that we target industries and subsectors that we understand best, where we can build trusted relationships and then identify further adjacencies. You can see this and how it works from looking at the evolution of the sectors we cover. Over the past 10 years in the region, we've evolved from being a generalist to a specialist by choosing specific subsectors rather than trying to be all things to all people. Now, some of these industries may look small and possibly a little quirky, like fund administration. But so did infrastructure when we began making strides in that 30 years ago. And in this market, whilst all of these subsectors will not be as large as infrastructure, they can be large. They can be really large, particularly when they're supported by big secular growth trends. Now, we see many similar expansion opportunities in this market, but we have to take a careful approach. When we're hiring people, character, fit, and culture really matter. Sam Shah and David Berman, they're going to talk to us about how valuable this specialised knowledge and relationships are to our clients. I think it's also important to note that we're in the flow with asset owners of all types, whether it be VC, growth, entrepreneurs, developers, private equity, corporates, infrastructure and pension funds. And that helps the development of our business overall. As these relationships and networks deepen, business just becomes a little bit easier, and clients typically come to us for other products, and that allows us to further differentiate ourselves. It could be a staple financing, could be a co-investment solution, or solving a complex carve-out with our advice and capital. And this strategy of focusing on depth is working. In the past 10 years, America's fee revenue has grown over threefold, and the region contributed almost half of Macquarie Capital's fee revenue in 22. And it is worth noting that our headcount is not radically higher than it was actually a decade ago. Drilling down, you can see how this is being driven by the strategy I've just outlined. Sponsor income has increased sixfold. And look at the example of what we've done in some of our core sectors, where we've grown fee revenues over tenfold, a testament to our teams and the deep relationships that they've built in those sectors. We are in a market-facing business, and that means it can be volatile. That's the nature of it. But by specialising in chosen areas and building deep client relationships, we're trying to position ourselves for success in the medium term. Now, these statistics only relate to fee revenue. Our deep specialisations mean that we can better use the balance sheet to support clients and build businesses because we have the conviction. And that brings us to our principal strategies. So our specialisation translates over to our principal investing activities, where we've had a consistent track record, recycling capital at attractive returns. We built a $20 billion global principal portfolio across multiple strategies in debt and equity. In its current state, we have a growing allocation to private credit, and we're building more recurring income from a portfolio that's growing net interest returns over time. Now, this portfolio is predominantly senior secured, and the high standards in direct lending we've maintained is evidenced by the low loss rate. In short, our core focus is capital preservation rather than asset growth. And we've delivered very strong risk-adjusted returns on that basis. The 8% IRR that we've achieved is impressive when you consider over that period the base rate was below 200 basis points. Now, it's a similar story in equity investment, which is a core part of Macquarie Capital's history going back more than 2 decades. Since 2001, across all of our diversified strategies, we've delivered an IRR of 24%. Now, each of these strategies has varying hold periods based upon the underlying characteristics of those investments, but we've averaged out at around 2 to 3 years. Now, you can see the consistency of result on the slide of the returns for fully realised transactions on a vintage by vintage basis. Except for a couple of outliers, the GFC, for example, we've consistently delivered returns in line with that long-term performance number. Looking at our credit strategies, our integrated approach to private credit is a key differentiating factor for us compared to our peers. We focus where we can create and unlock value for clients. We saw the potential for this market leveraging our strong financial sponsor network and our ability to provide both a direct lending solution and a syndicated underwriting option makes us highly relevant for our clients. They can choose which structure is best for them in their situation. And this important client solution has been no more relevant than the last year, where we've seen a slowdown in those syndicated markets. On the corporate credit side, you'll hear more from Bill Ekman, who leads that team soon. And on real estate, you heard from Tom in the video that we're investing across the capital structure in such subsectors as multifamily and hospitality, building on our long track record of investing in real assets. And Jackie Hamilton, who co-heads that area globally for us, is in the audience and based here in New York. Now, equity investing is a true differentiator for us with clients. And it also helps attract staff who value the ability to be able to partner with their clients. Leveraging expertise developed over many years, we focused our strategies in specialist areas, adapting our offering in each market, and you're going to hear more about them today. We're focused on technology investing, where we span key subsectors such as regulatory technology, education technology, government technology, AI, and more. And we take great pride also in our infrastructure heritage as a key global and local differentiator for us. Our team includes not only financial professionals, but engineers, developers, and other relevant experts to help us develop our infrastructure projects, as Alex said earlier. Now, our infrastructure business suffered a terrible tragedy this year, and at this point I'd just like to take a moment to pause and pay our respects to a colleague, Sarah Schick, who lost her life in January this year in a cycling accident. Sarah had been leading our P3 effort here in the region, and the main image in the materials for this tour is a bridge in Pennsylvania where we're bringing billions of dollars to a renewal project. Sarah and her team made that project happen. And Sarah really believed in the role she and we were playing in improving communities through infrastructure development. So I want to take a moment to recognise Sarah and all she's done. We'll obviously continue on this quest, but we truly miss her as a friend and a colleague. So, transitioning back to the presentation, I want to talk about our risk management approach. One of the key reasons for our strong track record in principle is risk management. And consistent with our role as being entrepreneurial and taking risk, it's just a core part of our approach. Now, none of this is new. We've always owned the risk. We seek to understand the worst case outcomes, and our risk management group is always working alongside us to provide important independent oversight. And it's important to note that risk management isn't just about principle, it's fundamental to everything we do. We form a deep understanding of the exposures in our business, both financial and non-financial. And we bring the same approach to our clients as we do to ourselves. As it relates to MacCap, we experiment a lot. We try new things and we learn a lot of lessons. But with RMG's help, we try and learn them only once. We learn from our failures and we adapt. Now, I started my career in RMG Risk Management Group in Sydney, so I've seen this from both vantage points, and I've seen it evolve a lot over the last quarter century. One example is actually cybersecurity, which is becoming increasingly important and starting to garner as much attention as traditional financial risks. An understanding of these risks also presents opportunity. And as the use of technology and compliance increases, we pursued it from a tech investing perspective. We've recently invested in such companies as XM Cyber, a company called Business Keeper, which was focused on whistleblowing software, and most recently Shield, a software solution for compliance in financial institutions focused on e-surveillance. And we are proud that risk management is an integral part of our culture. Now, turning to our culture, as you'll hear today, we encourage a pioneering spirit. We embrace our role as a dynamic, client-facing, somewhat vanguard of the group, connecting our networks to identify and create opportunities. To do that, we need to be collaborative. We're working across teams and with the rest of Macquarie. This allows us to deliver the group's products to our clients, such as referring opportunities across the group or hedging with CGM, and you'll hear more about that tomorrow. We also are very focused on DEI and are making real strides, and I think now is a good time to recognise in this time zone, it's International Women's Day. And I'm not sure whether you got a chance, but Shamara spoke to Ambassador Kennedy back in Sydney just yesterday, and it's a really important day that we all should celebrate. And DEI is a key part of the diversity of thought that we're trying to bring to our culture in Macquarie Capital and the group. Now, from a business perspective, we really pride ourselves on being solutions providers. We do not want to be just transaction facilitators, and you'll hear some of these stories brought to life today by the team. And we remain disciplined on what we don't do. It's important that you can say no to transactions. And if we aren't the right fit for a specific client and a specific client need, we communicate this clearly to our clients and decisively and move on. And what we find is clients appreciate our straightforward approach of being honest and forthright. Ultimately, it's our culture that empowers our staff to find the solutions and build the businesses that you're going to hear about today and help all of our stakeholders do better. And that culture is a core reason why our staff want to work here, as you heard in the video. So I'm really delighted that you're going to hear from a number of them today. Before we look forward, we should take a quick look back at the last time we focused on Macquarie Capital at the Ops briefing in 2021. And you'll see that our strategy remains consistent. We are still at its core a market-facing business that's geared towards M&A activity. But we have broadened our base, we've grown our recurring revenue, and we've diversified across regions, sectors, and products. We focused on depth and adjacent growth, using the balance sheet and doing it all with a culture of collaboration and innovation. All of this strategy is relevant here in the Americas, and you'll hear more specific areas of the delivery against this strategy shortly. So I've sought to give you a sense of how Macquarie pursues opportunities in this market and the sheer size of the opportunity in front of us. But now I'm really excited to hand over to some of our Americas leadership who'll share how they do this every day in the region. Sam and David will talk about the benefits we bring to clients in Macquarie by picking niches and going deep. Mickey will share how we've decided to be different and bring relevance to our clients in research. You'll get a sense from Tom and Plern for the market opportunity from the shift to private capital and why private equity and infrastructure funds are such an important client base for us. And finally, you'll hear from Bill, Larry and John, three of our principal strategy leads, about how we bring the balance sheet to bear and deliver strong outcomes for the portfolio, companies and our investors. Underpinning all of this, I hope you get a sense for our culture and our people. But before we hear from the rest of our speakers today, I wanted you to hear from those we serve first and foremost. One of our clients, Sam Rees at Vistage. Thank you.
Vistage is the world's largest CEO coaching organization, and we focus on small and mid-sized businesses. I've been the CEO for just over 7 years, but I was actually a member for a decade before that, so I know the business really well. And for us, we have this really clear purpose. We say that we help high-integrity leaders make great decisions that benefit their companies, their families, and their communities. And why that's so important to us is we really see these small and mid-sized business owners as the heroes of their community. So the core of Vistage is a peer advisory group. Sit around with 12 to 15 other CEOs of non-competing industries that are going through the same challenges that you're going through. The opportunities are amazing. I think what gets us so excited about the work that we do is the leaders we work with have a cascading effect on everybody they deal with, all their employees, their families, their communities. So we get these leaders actually making their work a great place to be at. Imagine like a Vistage company, if you have a Vistage leader, employees are valued, input is taken everywhere, CEOs are generous, they understand that they want full transparency. When we create that, one member at a time in our 43,000 members across the globe, that cascades to millions of people. And that's what we think we're really doing. We really think that we're making the business world better because of the work that we do. Macquarie has been a great partner for us. What Macquarie did is Macquarie came in and gave me a realistic picture of what my business was worth, what I'd have to do to sell it. Didn't try and paint it too rosy, let me know that there's, a little bit of blemish that I had to fix. And so the first time I heard that, I didn't want to hear it. I wanted to hear the other one, the competing firm, tell me how great I was, and they're going to go get a bigger transaction. But that has always been Macquarie's approach. It was all about what is your strategy, how do you create value, and how do we tell that story? And that is what made them and continues to make that team different than other teams that I've interviewed in the past. Because we're not trying to do anything crazy except for we believe in what we do every day, we believe we have a great business, and we're trying to grow in a way that's methodical and a way that stays healthy. I think Macquarie is different than their competitors in a lot of ways. First of all, everybody claims to be relationship oriented. That's what everybody's mantra is, but they truly are. Macquarie isn't looking for anything to happen with a quick hit. They take their time, they really understand the business. And what happens is when you take the time to do that, then I trust them to go have conversations on my behalf. Macquarie has a great team approach here. So you're not having calls with 5 people rehashing what you've already talked to one person about. They cascade it very, very clearly. There's a work ethic behind them that we really respect because we have a great work ethic here. So they're really cut from the same cloth as we are. Very strategic, hardworking, relationship oriented. When I think about the Macquarie partnership moving forward, I think there's a bright future for us all. They believe so much in our business that they invest in our business, for example. Having them connected to us as an investor also means that they're going to stay close to this business. I know the next time we're ready for another transaction, they'll be the partner that I choose. The great thing about our partnership too is they'll continue to get visibility to our business, and I want that because they help me shape this story and shape our strategy towards the future, so I don't just get focused on 1 year at a time, making sure that they help me keep an eye on the ultimate goal, and that is to create a lot of value for the 30 plus people that have ownership in this business and to fulfill our purpose of helping high integrity leaders make great decisions that benefit their companies, families, and communities. And so it was a blast working with them. Not only did we have a successful outcome, but it was a blast working with them. And I just think the world of the entire team. I just think the world of them.
Hello, I'm David Berman. I am co-head of Macquarie Capital here in the Americas. I also lead our consumer gaming and leisure business on a global basis. We're here to talk about what's been our success, what's been our differentiated approach. And maybe if I can take a moment to talk about my background as a segue and contextualize that, I think it could be helpful. I've been a banker for 30 years, both at bulge bracket firms and boutiques. In fact, I left Credit Suisse to start my own boutique advisory firm, in that case focused on consumer gaming and leisure. That firm was rooted in deep domain expertise, best-in-class execution, and leveraging, in my case, decades-long client relationships and delivering trusted advice. I met Michael Silverton and the Macquarie team 12 years ago and had that aha moment. Bringing my content and my relationships to the Macquarie engine was an obvious fit for success. We've seen that work time and again, Sam bringing his business from Credit Suisse to Macquarie in a very successful manner, expanding it as well. And we've seen that with bankers we've developed from a young age over the last 10 or 15 years in that culture to bring, again, a differentiated approach to our clients that is deeply rooted in domain expertise and content, forward-thinking entrepreneurial ideas, delivering capital, whether syndicated through the capital markets or off of our own balance sheet, and that's been quite a successful outcome for us. When you look at our approach, some of these may seem obvious, but an integrated approach that leverages our entire team, whether on a regional basis, on a product basis, even other groups within Macquarie that are outside of Macquarie Capital, it's bringing all that team together, low silos, high collaboration, great outcomes. Secondly, we've touched on the strategic advice. Again, being deeply rooted in niches, segments, sectors, whatever you want to call it, but having a team deeply focused in those spaces, bringing thoughtful advice to our clients, earning that role as a trusted advisor, which has led to quite a bit of repeat business. And the reputation within a sector of having that expertise has led us to a lot of new business by just having a strong reputation. Sam?
Great. Thank you, David. Again, Sam Shaw. I co-head Macquarie Capital in the Americas and lead our software and services franchise globally. I've been a banker for 20 years, and as David alluded to, I joined here about 7 years ago, also from Credit Suisse. What originally drew me to Macquarie was the solutions-based approach that we talk about. And, you know, in the Americas, as Michael alluded to, it's a very big opportunity, but it's also a very competitive market. And so differentiation has really been our call to arms. And how we differentiate, as you saw in Sam Reese's video, is through being rooted in solutions, unique solutions. And so in the US market where we compete, you know, there's obviously many good advisory firms. There are many good capital facilitation firms, but very few that bring together the marriage of advisory, capital facilitation, and principal the way Macquarie Capital does. Second, as we think about creating that differentiation, it's really been leveraging a lot of our legacy in some core sectors such as infrastructure, bringing those competencies to bear to open up new opportunities. Speaking of markets like education, marrying the capabilities we've had and the legacy we've had in infrastructure for several decades has allowed us to create some very unique opportunities to work with some of our clients hand in hand to create multi-billion-dollar companies, sometimes from scratch. And then finally, as we think about the culture, creativity, and innovation, it's really rooted in two fundamental elements. The first being entrepreneurialism. And we really think of ourselves as entrepreneurs helping other entrepreneurs. And in doing so, we don't chase league tables. We don't try to be all things to all people. But what we really do is help unleash our world's entrepreneurs to solve our society's most complex problems. And when we take that type of an approach, it's created some very, very outstanding outcomes for our clients and our stakeholders.
I agree, Sam. And if we turn to the next slide, you think about what are some of those niches. And as Michael alluded to, they may sound niche-y, but in this kind of market, we're looking at these large TAM, tailwind-backed sectors where change is taking place and strategic advice is needed. So insurance brokerage, a great example. Highly large, global-oriented, highly fragmented, perfectly positioned for consolidation, and a breadth and depth of knowledge across a number of regions that has led to a very successful business. In the Americas, we've had in the past 2 years 30 successful advisory transactions completed where the Americas team played a role in a cross-border transaction. So we're seeing more and more of that momentum. Gaming and entertainment is another great example. Large growing TAM, leisure time, disposable income, and we focused on both land-based gaming and entertainment assets as well as online and digital. So you think about COVID happening, land-based operators anxiously looking for a way to get to their customer in the home, and then coming out of COVID in home entertainment, how to stay in touch with those customers over time. So morphing to an omni-channel strategy and us being able to take our expertise in one segment, tie it with the expertise in another segment, marry up a lot of combinations, and that's been a successful outcome for us.
Yeah, and speaking of taking some of our legacy efforts and then moving them into new domains, areas like federal services, or government services, Core Plus, education software are all very good examples of that. To the extent you're not familiar with the notion of federal services, what that means, believe it or not, it's actually a very significant sector in the U.S. As you can see, about $135 billion a year spent alone just on IT related to government services. And so we've identified a new niche, which is in and of itself a massive niche, and then used both advisory and principal solutions to drive some very outstanding outcomes, some of which Larry will speak to here in a bit. As we think to infrastructure and Core Plus, one of the nuances of infrastructure is that the definition or the purview of infrastructure has grown over time. And so infrastructure now that was relegated to bridges and roads is now moving into areas like data centers or education or other areas where many of these new funds are raising significant funds to pursue some of these opportunities, and we feel that we're right in the square of that opportunity set. And then, speaking of education software, there's been no area that's been more impacted given COVID and the significant learning loss that's happened with many of our children over the past several years. And speaking to kind of the entrepreneurial culture and the nimbleness of our platform, we very quickly pivoted to that space in a way where we've executed tens of billions of dollars of transactions over an extended period of time, as well as being a very significant principal investor in that space.
Maybe to dig in deeper to some specific examples, you look at the AUB transaction, AUSTRAC as you may know it as in Australia. Here is a situation where we advised an Australian-based client buying a UK business owned by a US private equity firm. So again, sounds simple, but had Marianne and Sydney not been collaborating with Johnny in London, with Mark in New York, Tom and his team that cover the private equity firms out of LA, and had dialogue, we wouldn't have been able to offer a seamless execution like we did in this case. When you talk about long-term relationships and leading with forward-thinking ideas and being that trusted advisor, Light & Wonder used to be known as Scientific Games, is a great example. This was a company controlled by Ronald Perlman. Over time, we had sold him 3 businesses, over $7 billion worth of gaming assets to expand with his lottery business. As COVID came, high-levered company comes to issues. Ronald looks to sell his 35% stake in the business. We advised the former Aristocrat leadership team, for you Australians may know Aristocrat well, combined them with Caledonia, big private equity, to acquire that stake. Now what do you do with this stake? You look to de-lever the company and position it for growth. So we helped them sell 2 different businesses, the largest being their lottery business, a $6 billion business, and then an online sports betting business that sold on a revenue multiple basis, so thus really de-levering the balance sheet. To touch on Sam's comment, the lottery sale is also interesting when you talk about infrastructure and the convergence of some of these industries. This is a business that's 10 to 15-year contracts, government counterparty, sounds a little infrastructure-like. Sure enough, we sold it to Brookfield at more of an infrastructure-like multiple, well in excess of what the client was expecting. This kind of trusted advisor, entrepreneurial mindset has led to a long-term relationship. We've completed 17 transactions, either advisory or capital markets, with Light & Wonder in the 11 years I've been here.
Speaking of being a solutions provider, as Michael alluded to, our expertise and depth within niches allows us to step up for clients in tumultuous times. LMI is a very good example of that. A government services company that was transacting in the middle of last year in the midst of the market tumult. Not only do we serve as an M&A advisor, but also a principal investor. And when we think about solutions orientation and the ability to navigate markets, in good times and bad, while still having an eye to risk, given our incumbency in some of these spaces, allows us to do things that many of our competitors cannot. On the new and converging sectors, as I've alluded to, in areas like infrastructure and energy, where we can bring together core competencies, we're able to drive very significant and unique results, as we did in the case with Diff, and Bernard on their transaction last year. And then finally, when we think about the culture of creativity and innovation, again, the notion of entrepreneurs helping entrepreneurs, really great reading is a very good example of that. 2 school teachers, entrepreneurs that bootstrapped a business tied to literacy for children. And no more relevance for that type of a product set, in the midst of COVID with the significant learning loss. We work with that company in the midst of the market tumult late last year, got a very, very high multiple for that business, brought in a private equity firm that was a very good client, and allowed that investor to roll with a social impact-oriented fund. And so if we think about our culture of creativity and innovation, no better example of that. And worth mentioning that while we're diving into certain niches, the nuance or the beauty, candidly, of the U.S. or the Americas markets is that these are one of several hundreds of niches that we can go into that in and of themselves are multi-billion-dollar opportunities. When I joined here again 7 years ago, education, for example, was a very small niche, and today it's obviously a multi-million-dollar business. There are many, many of those types of niches that we're, unlocking each and every day.
Thank you.
Thank you.
Mickey, you want to come up, please?
Hi, everyone. My name is Mickey Edelman. I've been with Macquarie for about 15 years, and I've had an amazing experience working all over the globe for us in Asia, in London, and back home here now in the US. And I think all of those experiences have been really valuable in terms of being able to think about how we can shape businesses and how we can kind of be relevant in markets. And when the equities business became a part of Macquarie Capital in 2020, we had an opportunity to really ask ourselves, how can we be relevant to investors here? How can we be relevant to corporates? How can we be relevant to Macquarie as well? And so we decided to focus our US equities business on 3 areas. The first of those areas is US research. Now, this is not a broad research product. As David and Sam were saying, we actually focus on areas in our domain expertise. So we're very specialized in that regard. And there will be parallels to what David and Sam just talked about. We also decided to, as Michael Silverton said earlier, kind of double down on that Asia-Pacific strength that we have. We have served as a bridge going from east to west and west to east, and we really see ourselves as being that gateway for investors in this region, bringing our leading ECM distribution franchise out here, for example, and also our leading corporate access activities here as well. And the third area of focus for us in this region is around global execution. But really where we're focused here is the strength of our global program trading business and what areas of adjacent opportunities we could have, such as transition management, global transition management, and also a new business that we've started around international ETF creation redemption, which I'll talk a little bit more about. Let me dive a little bit deeper into our research business. If you think about our team, I've listed our sector heads there, but largely it divides into 2 different groups, consumer and technology, which I'll call software and technology-enabled services. But on the consumer side of things, we're not looking at it as a traditional GICS sector breakdown. We're not looking at it as soft lines or hard lines. We've actually asked our research team to please take a look at the ecosystems. focus on how those ecosystems are developing and changing and trying to provide some insight into that. So let me give you an example. Our consumer team wrote a report called There's No I in Team. And this was where our online gaming analyst, our media analyst, and our live events analyst, or our stadium analyst, all realized that these disparate sectors were starting to form partnerships and creating, in fact, a new ecosystem. And so they wrote about that new ecosystem and how that addressable market was actually changing for these once disparate sectors. Our technology team also does the same thing. They've written on a number of different thematics as well. One of those thematics is, around the future of work adaptation, or 5G is the fabric of Internet of Things. And I've actually put on your chairs the report that they just published this week, looking at the $10 billion acquisition that Microsoft made of OpenAI. Now, what's interesting, though, about this ecosystem report is that this dives deep into the public and private ecosystem intersection. We've had lots of interest from investors in this region who have asked us, when we talk about public companies, to also provide insight into unlisted companies and how that is having an impact on these areas. And so our team came together to do a deep dive into what this is going to mean going forward, not just for Microsoft, for the search industry, also for the advertising industry, what unlisted companies to focus on today, and what unlisted companies should be focused on in the future. And when you see that early alpha branding from us, you'll know that that's a report that looks at that private-public ecosystem interaction. But I think what that report shows and what these examples shows is that we try to be nimble, we try to be collaborative, we really rely on our deeply connected domain expertise to deliver thought leadership in this market. Now let me touch base just on our new business that we've created here in the US around international ETF creation redemption. This is where we act as an authorized participant for ETF issuers. ETFs are largely traded in the secondary market by retail investors, but there is a need to actually create liquidity for institutional investors in the primary market, and that's where authorized participants come into play. We create that liquidity in that primary market. The reason we see an opportunity here is because this is an adjacent business to our global program trading business. If you look at the Asia-Pacific region and the growth in ETF assets under management, although it's growing, it's still just a single-digit percentage of the total global financial market assets under management. So we see tremendous tailwinds that can come from that. So we've basically combined our global program trading expertise in an adjacent business. We are leveraging the strength of our Asia-Pacific core business, and we are providing US ETF issuers that have Asia underlying components with an opportunity to create liquidity in that primary market for them. And for us, it allows us to capture an opportunity that we see as a long-term tailwind. That's a snapshot of our US equities business. I will now hand it over to my colleague, Tom Amster. Tom?
Great, good morning. Thank you, everyone. I'm Tom Amster. I'm global head of our financial sponsor coverage business. I'm based in Los Angeles. It's a strange winter when the weather in New York is better than the weather in Los Angeles, but that's what we've seen so far this year, and it's a beautiful day today, and thank you for joining us. I've been doing this for 26 years. I did this for 2 banks before this for 20 years and joined Macquarie Capital 6 years ago to run this sponsor coverage business. This is by far the best culture that I've been involved in. It's a culture of cooperation. It's a culture of entrepreneurialism. And importantly, it's got an investor mindset, and you're hearing that as a thematic throughout the presentation today. But that's unique. So when people say, Tom, what do you guys do that's different than what other folks do? It's bringing that investor mindset to the coverage of our sponsors. And you'll hear from the principal finance team later about how we deploy principal equity and principal debt alongside our clients to help them achieve their objectives. So let's talk a little bit about what the market opportunity is. Key number we'll focus on is $800 billion of dry powder. Dry powder is long-term, locked-in capital that our clients have raised that they haven't yet deployed. It's our very good client that I've covered for almost 20 years in Los Angeles, Leonard Green & Partners. They have $20 billion of dry powder. But but they're leveraged buyouts and not just equity buyouts. This $800 billion in a conservative capital structure of 50% debt and 50% equity represents $1.6 trillion of purchasing power. Just put that in a little perspective, the annual GDP of Australia in US dollars is approximately $1.6 trillion as well. So you could see it's a huge market opportunity, and it's why we're so excited about it. There's more good news too, which is that our clients, they don't store capital, they recycle capital. So they're continuously out there rebuilding this pool of capital. And when you think about the fee opportunity that $1.6 trillion of capital represents, you could see again why we're so excited. And these opportunities touch everything we do in Macquarie Capital. It's advisory, it's debt, and that includes both our syndicated debt product as well as our direct lending product. It's partnering with the principal finance team on equity. It's increasingly on the infrastructure side. And certainly the fundraising environment's gotten more difficult. We're in a bit of a subdued market environment, but it hasn't stopped our clients from successfully raising capital. So in 2022, on a calendar year basis, we saw firms like Advent International and Thoma Bravo go out and raise $20 billion funds. And as we look to 2023, we expect other significant and good clients of ours, including Apollo, Blackstone, Carlyle, Hellman & Friedman, and Vista to go out and raise funds of $20 billion and more. And so as we think about the opportunity and what we're excited about, I say to people, we like to grow with our clients, and we like to follow the capital. And so what do I mean by that? You know, in thinking about growing with our clients, if we were here 10 years ago and talking about Vista Capital Partners, who's a leading investor in the software space, that fund size was $3 billion. Now that fund is $20 billion. If we looked at Veritas, and we were standing here 10 years ago, that fund size was $1.2 billion, and now it's over $10 billion. And so we grow with them from a size standpoint, but we also grow with them from an industry standpoint. So think about Veritas, who started off in the aerospace, defense, and government services sector. They've now expanded the sectors that they look at, and we've expanded alongside them. So now we're helping them in education, and we're helping them in healthcare, we're helping them in technology. And we are the manager of the global relationship for Macquarie Group as well. And so when Shamara comes to New York and she visits with Blackstone, and she wants to know about the 24 different places that we touch Blackstone, she comes to the MacCap Financial Sponsor Coverage Group to get that update. In that role as well, we source opportunities for the rest of Macquarie Group. So for example, last year we helped source more interest rate hedging solutions, which is run out of our CGM group, and you'll hear more about specifically tomorrow when you're in Texas, for the team as well. Let's go to a case study, which really highlights the virtuous cycle of repeat transactions that our private equity clients do. And this is what happens when you marry skilled execution, great industry coverage, good sponsor coverage, and principal investing opportunities. And as I mentioned, it really creates this virtuous cycle. So McGraw-Hill Education, a company that many of you have heard of. It's been around for over 130 years. It was known largely as a publishing business. In 2013, Apollo Global Management, good client of ours, in a corporate carve-out, which is something they do extremely well, bought McGraw-Hill Education. Over the next 8 years, they transformed the business from a publisher to an online digital education content provider. And that transformation created a significant amount of value. So they came to us in 2021 and asked us to sell that business for them. So we were the sell-side M&A advisor. We sold it from one client, Apollo Global Management, to another client, Platinum Equity. In doing that, we receive a sell-side M&A fee. Platinum needs to finance that acquisition with debt. We were part of that financing consortium and received a buy-side acquisition fee. Just months later, another good client, Achieve 3000, which we happened to have a principal investment in, we sold to Platinum and McGraw-Hill. And there, a significant principal gain as well as an M&A sell-side mandate. And again, in order to fund the acquisition, Platinum McGraw-Hill needs more debt capital, and we help do that acquisition financing. So if you think about, and this is the best example of seeing this, in a very short time period, advisory, acquisition financing, principal gain. This is what it's all about. These are the opportunities we can continue to look forward to. This is why we're so excited about the business opportunity going forward. So appreciate your time. I'm going to hand it over to Plern, who will talk about the infrastructure side of private equity.
Thanks, Tom. Good morning. I'm Plern Benithan, and I lead the infrastructure sponsor coverage effort in the Americas. By way of background, I've been in banking for 13 years, and I previously spent 7 years at Deutsche Bank covering institutional clients prior to joining Macquarie in 2021. Infrastructure funds make up the other large bucket of capital in the private markets, in addition to the private equity sponsors that Tom just covered. Today, I want to outline Macquarie's unique business and coverage model in infrastructure and why we're incredibly well-positioned for the growth opportunity that lies ahead. Macquarie has been a leader in infrastructure for over 25 years. Our experience reaches back to 1994, when we underwrote and placed public equity for the Hills Motorway in Sydney. Since then, Macquarie has become the world's leading infrastructure manager, and we've also been the #1 infrastructure financial advisor globally for 7 consecutive years, and the #1 financial advisor for renewables in the US for the past 4 years. And this is just the tip of the iceberg in terms of our potential. We expect infrastructure fundraising and investment will continue to grow for decades, pushing the investment boundaries and the reach of these investors. Infrastructure fundraising has set new records in 3 of the past 4 years. Why? It's driven by demand for resilient, inflation-protected assets and strong global momentum to tackle decarbonization, which is still far from sufficient to reach net zero by 2050. These secular trends are providing energy transition opportunities across the economy, from electrical grid transformation to cleaner energy generation, transportation fuels, and industrial processes. In 2022, energy transition-specific fundraising exploded, with over 20 dedicated funds raised globally. Global investment in the sector reached $755 billion, more than $200 billion over the levels achieved in 2019. Here in the US, the trend will be further accelerated by the Inflation Reduction Act, which provides $369 billion in spending on energy security and climate change programs. Macquarie's leadership in infrastructure and our ability to be both a sponsor and an advisor means that we have an unparalleled relevance with our clients. Because of that, Macquarie is one of a few global banks that has a dedicated infrastructure sponsor coverage team known as Private Capital Markets. The team has 14 people on the ground across offices in Asia, Australia, the UK, and the US that can provide access to a massive pool of global capital. We cover multi-strat funds that invest in infrastructure, mid and large cap infrastructure dedicated funds, sovereign wealth funds, and pension plans who are early adopters of alternatives and real asset investing. Project returns are the key investment driver for our clients. They value creative problem solving, sector expertise, and strategic advice, which is where Macquarie can make an impact. Our team has a deep understanding of the competitive landscape, investor sector-specific approaches, and cost of capital. With record capital raising, infrastructure investors have broadened their risk appetite to core sector adjacencies. They've pushed into traditionally PE-dominated realms with investments in environmental services, education, and logistics. The Diff Capital Bernhard transaction that Sam referenced is an example of an infrastructure fund providing the most competitive capital for an energy services business. As a result of this trend, our clients are increasingly important players in the M&A landscape. This elevates the value of the team's insights and means that in infrastructure, we're increasingly collaborating and cross-selling our DCM capabilities and collaborating across advisory verticals with our colleagues in industrials, software and services, and financial institutions. The investor base we can deliver has longer investment horizons and lower cost of capital, and with Macquarie's advice on infrastructure like positioning, we can help maximize the value of our clients' assets. Our knowledge of infrastructure investors has become a linchpin for Macquarie to differentiate itself as an advisor across the sectors. Let me bring this to life for you with a case study which highlights our unique infrastructure model at play. In 2015, Macquarie developed a $400 million fiber optic network, P3, with the Commonwealth of Kentucky, one of the country's most technologically underserved states. The network provides critical connectivity for state agencies and services such as the police and fire department. At financial close, we leveraged our investor knowledge and relationships to bring a long-term sponsor to the project. And once the network was built, the state needed an operator who had the know-how to commercialize the excess capacity on the network. Macquarie stepped in and invested additional capital to develop a telecommunications business called Accelecom on top of the infrastructure asset that we developed. Once the business was sufficiently de-risked with initial customer contracts in place, the advisory team ran a capital raise and brought in another sponsor to diversify Accelecom's funding sources. Macquarie still retains a significant equity stake in this business alongside our partners, and in 2022, Accelecom acquired a fiber service provider in neighboring state Georgia, furthering its growth. This transaction tapped different investor appetite from a P3 investor to growth equity capital in the thematic area of digital expansion. Macquarie leveraged our in-house development skill sets across two very different ventures, as well as our coverage insights and advisory expertise to bring this multi-stage transaction full circle. Our truly differentiated and holistic infrastructure model is what allows us to execute innovative transactions like this and be thought leaders, which is the most exciting aspect of working at Macquarie for me. Thank you for joining us today, and with that, we'll take a short break and then hear about our principal strategies.
Bill Eckman. I'm head of Principal Finance Americas for Macquarie Capital. I've been now at Macquarie since 2014. Prior to that, I spent nearly a decade as a founding principal of a private credit firm, publicly traded private credit firm. And so I've been doing middle market investing now for about 20 years. So over the next few minutes, I will touch on the growing private credit market and Macquarie's position within that and how we focus on deal selection. The team here in the private credit group has a 14-year history, having invested more than $50 billion of private credit during that time, with an average annual realized loss rate of less than 30 basis points. But first, let me just step back and start with touching on what is private credit. So it's a term used to describe a transaction where a financing source provides a loan directly to a borrower without an intermediary in between, serving as an underwriter to arrange the deal. Now, private credit investors do fundamental due diligence with the intent to make the buy and hold investment until repayment, refinancing, or the maturity of the loan. During the due diligence process, the lender speaks directly to the client, to the borrower. They negotiate all the terms and documentation, and then they keep all the economics for themselves. Now, private credit is increasingly being utilized as a financing alternative, and that's because borrowers want to know who is in their investor base. So over the time, the borrower has this direct relationship, and they can speak directly to the decision maker at the lender. And that way, as a business's needs evolve, it's easier to have that direct dialogue and that direct communication. Furthermore, the transaction execution for a typical private credit deal is generally more streamlined, and you only have to deal with a few institutions to put together a loan. And again, you have that direct contact. The benefits of being a private credit investor, like myself, versus participating in more broad syndicated-like processes to generate deal flow includes enhanced due diligence, better documentation from the borrower, including improved information rights and tighter restrictions, as well as enhanced economics. So talk about the private credit market and the evolution. It's big, it's growing, and it's taking share from other forms of credit. Private credit comprised only 10% of the total credit market back in 2010. But now, after more than a decade of more than 10% annualized growth, the private credit market is nearing $1 trillion in market size and now comprises 30% of the total credit market. Its rapid ascent is expected to continue in all the forecasts, both in terms of absolute growth as well as market share penetration, as shown on this page. The Macquarie Capital Global Private Credit book today, as of 12/31, was more than $16 billion, about half of which is in the Americas. Due to the absolute growth of private credit and Macquarie's small market share in what is a very fragmented market, there is still plenty of room for Macquarie Capital Private Credit to continue its growth trajectory, providing strong risk-adjusted returns to the group. So what does Macquarie invest in? As to it, let me start first with our investment process. First, we need to find these deals. Where do we originate them? In addition to my investment team that has years of experience and strong relationships with borrowers and specifically private equity firms, we also utilize the broader Macquarie network, be it the industry bankers who provide deep domain expertise and can provide a differentiated sourcing edge versus our competition, Tom and his global sponsor coverage team, and even groups outside of Macquarie Capital. Other parts of Macquarie have touch points which help further penetrate into the private equity client base. As you'll hear tomorrow, two businesses in CGM, Pratap's fund finance business, and Glenn Edelson's hedging business consistently execute transactions with the private equity community. And so all of these just touch points within a client further bolster Macquarie's comprehensive and differentiated product offering, and it just keeps us top of mind in front of these clients. Now you can see here in this triangle chart, Macquarie, from a credit perspective, where we play and where we don't play, and where our focus area is. Our focus area is on senior secured debt. So this is the debt that sits at the top of the cap structure of the borrower where there's the least risk. So what that means is if something goes wrong and there's an impairment to the borrower, it's first the equity layer that's impacted, followed by the junior capital or the mezzanine layer, and then if and only if there's further impairment, would there be an impact to the senior secured debt capital layer. Nearly 95% of the private credit book of Macquarie Capital sits in this senior secured debt layer. And it's worth noting that where our security sits is right around 6 times cash flow. And this is on a relative basis to the value of the businesses we're investing in at the time of a private equity buyout or the implied valuation, but based on our fundamental due diligence of in excess of 18 times. So when I talk about this cushion of the equity layer, the junior capital layer that sits behind us, it's significant that those layers can absorb any losses before Macquarie is impaired. Now, as to the sectors we invest in, about 90% of the portfolio is really in 5 key areas. It's software and tech-enabled businesses, it's insurance services and brokerage, it's real estate, it's healthcare, and then it's business services, which include education and B2B services, for example. Now, what do these 5 sectors have in common? It's really 2 things. First and foremost, recurring revenue. There's a level of predictability, underlying predictability to the cash flows of these borrowers that we invest in. Be it software and tech-enabled businesses, where borrowers rely on that software on a daily basis in order to even operate. They need to pay their software bill. Insurance brokerage, where customers, whether it's individual consumers or the businesses, small, medium-sized businesses or larger businesses that need to renew their policies every year. Be it education, where there's a sizable student base that comes back. Or in healthcare, where there's an underlying demand, a level of inelasticity for the majority of the service offerings. The second thing these sectors all have in common, they're the power alleys for the broader Macquarie platform. As I mentioned, in addition to my investment team having years of experience in these sectors, investing across multiple borrowers, the Macquarie Capital industry teams and the industry bankers have entire teams dedicated to each of these sectors. So it's this deep domain expertise that you've heard about and you're hearing about again that can assist us in providing an edge as we do our credit underwriting and also as we utilize those teams to find incremental, differentiated deal flow for the private credit book. Last thing I would mention is talking about our funnel. So what I mean by that is all these deals come in, we look at it from a funnel perspective. What comes into the pipeline, but then what's the actual conversion rate to make it into the private credit book at Macquarie? And that ratio is a little bit under 5%. So that means we turn down a lot of deals. We're focused on senior secured risk, as I mentioned. We're focused on the sectors that we like. We do fundamental bottoms-up analysis through our intense due diligence process. This can consist a number of things that we have a full, each deal has a deal team allocated to it that analyzes the borrower's monthly performance metrics. They're calling third-party industry experts to get an impartial view. We're soliciting our own customer surveys. We're reviewing third-party commissioned reports, which can include financial report that cover the financials, the tax, the HR, the IT, general industry reports. So we have teams doing deep dives on every investment we make. And we do that so we can develop the conviction that not only will our interest and our principal be repaid at maturity, but what we are investing in offers compelling, alpha-generating, risk-adjusted returns for the broader group. So what does private credit mean for Macquarie? It means recurring revenue, which translates to recurring profit for the group. Now, why is the book recurring? On average, as I mentioned, each loan is on the books for approximately 3 years. But then some of those loans, when there's a repayment event that I mentioned, can stay on longer. And why is that? It's the value of being an incumbent lender to a middle market borrower. You have a much higher likelihood of staying in a credit once a new PE firm decides to buy this business. And that's because you've developed an expertise, an underlying base understanding of the business, which allows you to move quicker when the business is being sold from the other private credit competition that you're facing who also wants to invest in that business. The other thing that differentiates you to the value of incumbency is the partnership with the management team. When you're invested with a business, you get to work closely with that management team over a period of number of years. You develop that client relationship well. Then when it moves on to the next event, next ownership period, it just puts you at the forefront and top of mind with the decision makers on that next stage. So we have examples in our portfolio that have been in our portfolio for a decade across 2 or 3, even 3 different private equity owners. So as Tom alluded to earlier, Macquarie offers comprehensive, integrated product offering to its private equity clients. We all work together at MacCap to provide the best solution to the counterparty. There are a lot of firms out there that offer private credit solutions, and there's going to be more, just as there are a lot of banks out there that offer syndicated loan solutions. But we offer both, and that is differentiating. If a client wants a syndicated loan solution, the group makes money when we successfully syndicate down that risk and earn a fee. If a client wants the private credit solution, which is increasingly more the case, the product delivers strong risk-adjusted returns to the group at a 4.5% to 5% net interest income margin per deal for an average duration of 3 years. Finally, I'll finish up with, you've heard examples of companies where multiple prongs of Macquarie Capital were involved. David and Sam mentioned the insurance brokerage sector, so I'll touch on that with a specific example. My team and I met the founders of World Insurance in late 2015. And then we closed a deal in early 2016 where we provided both debt and minority equity. We provided, over the years, significant amount of incremental capital to scale the business as it grew organically and as it grew through tuck-in M&A opportunities. And then the Macquarie Capital FIG team, led by Dan and Eric, helped sell a control stake in the business to a private equity client. And since that time, my team has maintained a lead role with now a $150 million investment, and we're the lead lender. We have the agency position on that, and we're currently scaled our investment to that size. So this is just a tangible example of the value of Macquarie and its private credit platform and what it can bring to clients. Thanks. Larry?
Great, thanks, Bill. Hello, everyone. My name's Larry Handon. I lead the Global Growth and Technology Group here within Macquarie. I joined about 10 years ago. For that, I spent 10 years as a partner at Insight Ventures. I'm fortunate enough to lead a group of MDs and SMDs that have got more than 20 years of relevant experience, and we as a group have worked together for more than 5 years. And when you also, I'm going to change the slide. When you think about what we do, it's very simple. We are goal investors, growth-oriented, asset-light investors in tech and tech-enabled services, okay? More specifically, we're trying to narrow our focus in 4 different ways. The first is sector. We're B2B or B2G, business to government. Within that, we try and look at 3 different areas. One is we call it the doing well by doing good. You've heard government, healthcare, education over and over again. That's something we've done since, for the last 10 years, okay? The second thing we're looking at is fintech. No surprise, we're a big financial institution. And the third thing that we like to spend a lot of time on is something that's a really interesting concept, and it's using technology to solve capacity-constrained issues. In other words, is there a virtual solution instead of a physical solution, all right? Like every other firm, we have a series of financial and operational metrics that we use to sort of zero in and decide what we like. I'm not going to take you through all of them. I'll just say, look, they're organized in 3 different categories. How good's the company? Okay. Bill talked about some of those characteristics. How good is the management team? We are very much about the people. And what is the quality of the opportunity? Okay, look, if we're not doing a reasonable chance of 25% chance or better of winning this, we're not going to spend time. It's not a good use of our time. It's not a good use of the company's time. When you think about where we fit within the capital structure, one of the great things about Macquarie is we're very flexible. We could be in any part of the capital structure, but as a matter of fact, we're basically somewhere between the pref and control in terms of the type of investments we make and we do that in either late stage venture or mature companies, occasionally taking a look at take privates. We are a global organization. That being said, we spend almost all of our time in North America, followed by Western Europe, and then ANZ as sort of the smallest area that we're going to spend our time in, okay? So the next logical question is, okay, you picked these areas. Why did you pick these areas to focus on? And if you look at the macros, to start with, it's a super easy answer, okay? Governments throughout the world, not just the United States, are spending more in absolute dollars and as a percentage, okay, of GDP every year, and they're going to continue to do that for the foreseeable future. And they're doing it because in the second chart here, the population growth is not only growing, at a fairly significant rate, it's getting richer. And as this population gets richer, they're demanding more and more services of their government. At the same time, what's happening to resources? Well, they're not making any more natural resources, we know that, okay? And infrastructure, again, is also being taxed. Then you wrap it up on the fintech side. I think the easiest analogy is someone once told me that you're going to use your wallet in 2050 about as much as you use a fax machine, okay? So the transactions that we see today are going to be completely different 20 years from now, and we want to participate in that. Now you take all these great macro tailwinds, and then you overlay our reputation, our capability, our resources as a firm, not just Macquarie Capital, Macquarie broadly writ, it gives us a tremendous competitive advantage. In fact, we talk about, why we win. Why do we deserve to win? Okay, it's 3 things. One is we will have spent a lot of time with you. Not always, I want to be clear, if there's something that comes in, we're going to support and look at that deal. But by and large, we've spent multiple meetings, multiple sessions with you, often over multiple years, okay, getting to know you, and more importantly, letting you get to know us, see if we're going to be a good fit, is someone you want to work with, okay? And then we have a huge competitive advantage. We are not a fund, okay? Most of the companies, we talk about funds and funds doing investments. They have a 5-year hold period, You can go 5 more years with 2-year extension. That means if you need a little bit more capital or a lot more capital and you're not in the right cycle, or you need to be in a different part of the capital structure, that's very hard for a fund to do. Even if you're not going to take us up on that offering, it's very comforting if you're a company knowing that we can always be there for you. There's no clock ticking. And by the same token, if you need to get out early, we're not going to tell you to work for 3 more years because we need our 3x return. Okay. And then the final component is this wheel, which I'd like to cover each and every one of them, but I'll just cut to the chase, which is we have a whole host of capabilities that we can bring to the company post-close to build value. A lot of people say, like, we're the world's greatest pickers of companies. We just get the price right every time. We're saying, look, we don't know if we get the price right every time. We're better investors in better companies, and we're going to work as hard as possible, bringing as many resources to make a good company great, okay? Or a great company even better. The portfolio, I will just speak at a very high level. This is just some representative investments of the portfolio. You can see, at one point in time I had an asterisk. It's a very, very tiny asterisk about exits, okay? So if you've got, 2010 vision, you can see about a third of the portfolio exited. We spent most of calendar year 2021 selling, not investing, okay? And that turned out to be fortuitous. Not only was it great from a return standpoint, but we really reduced the size of our book. In fact, our book is at a really low rate relative to where we feel we're capable of running and managing. We've been threading back up. The markets have corrected within our sector about 50-60% on the public side, but the private side's only corrected about 25%, okay? In some of our areas like public sector and some of the capacity constraint, there are plenty of opportunities without the market continuing to fall. But I think in some of the fintech stuff, we're going to continue to be active, but we still think there's some room for that market to come back down in. But again, plenty of opportunities, even though we think valuations are high relative to where they may ultimately be. I'm going to wrap it up with a case study, just to sort of give you an example of what we do and why we do it. This is not an exit. This is a relatively recent entrance. We talk about sort of this thematic investing. One of our theses is within the government service sectors, we feel states and counties and municipalities and provinces want to serve their constituents better. I mean, people sometimes tease governments, but governments really want to provide value to their citizens. So we went out looking for solutions where you could improve value to the citizens. And one of those areas that we thought of, which is sort of anathema to Australia, which is very far ahead of the schedule, is the payment space. So if you want to get a business license, pay your taxes, register your car online, most of the places in the United States and a lot of places in Canada, you can't do that. You write a check, you go into an office. It's very, very difficult, and it's very difficult to check and see whether you've got an open balance or a traffic ticket that you shouldn't be able to do. So we spent about 2 years talking to not hundreds of companies, but scores of companies, probably 20 or less, and then talking to some of the governments that use these. And we found Payit, and Payit continually came back as, look, the best clients were most interested in them, but it was small for us at the time. So we followed it over 2 years, and then over the summer, they had some recent wins. They scaled up, and it became a good opportunity for us to make investments. So we went in, we put in a significant minority investment. So again, some are controlled, some are minority. This is a significant minority investment. It's got structure, meaning it's got good downside protection. There's little if no debt ahead of us. It's got some embedded profit in it. And if the company performs to our expectations and we're helping them perform that expectations, it's going to be a great traditional equity return for us, okay? And even though we've been in there, just a few months, we're already working to apply value. It's a great company, it's well run, but we did come in there, we worked with them to recruit 2 new senior executives, which they needed. We came in there and we helped them rework their KPIs, and 2 significant operational things. One is the time to implement, which is how quickly are they going to get to revenue so they can make revenue. And most importantly, I think, is how are their clients using the product, right? You're not delivering any value if the citizens aren't using the product, because the government doesn't get any benefit. We don't get any benefit from a revenue standpoint. So when you put that all together, we saw pipeline grow 25% since we came in there, I think in part, not all, because of our participation. And we saw utilization, which is just a proxy of revenue, grow 3-fold, again, just in the simple time that we've been there. So, that's all I've got for today. With that, I'm going to bring up John Pickover, and I thank you for your time.
Thank you very much, Larry. John Pickhaver. Nice to see everybody here in New York, and I recognise many of you from my former role as the co-head of Macquarie Capital in Australia and New Zealand and leading the infrastructure team there for the last sort of 8 years or so combined. And I've newly arrived in New York to lead our infrastructure and energy capital team here for the Americas. So Infrastructure and Energy Capital is the name of the team within Macquarie Capital that is responsible for the principal investing, project development, asset creation activities within Macquarie Capital. It's focused on our heritage, infrastructure and energy parts of the business. And it's been this team that's been good at finding all of the various opportunities for us to deploy capital into this infrastructure growth and energy growth sector. So we're creating assets, we're creating businesses, and ultimately making those businesses and opportunities investable for others as we recycle our capital and grow and develop those assets. And so the IEC business here is the business that's driving that. As you've heard, it's this team that recently grew the GIG business that's now moved out to MAM, but over the years, this has been the team that's grown sort of airports, funds, toll roads, aircraft leasing and so forth, and this is just the latest iteration of this heritage business of ours. So when you look at what we do in infrastructure and energy capital, we're focused on 3 industrial sectors. So economic and social infrastructure, we're focused on digital infrastructure, and energy transition infrastructure. And we can invest into that thematic across a number of different stages. So classically in the development stage, we're bidding to design and then build these assets through, and we work through with developers at the early stage. Through construction, we're happy to own assets and support assets and companies through the construction phase. And then into operations. We're not really focused on operations for operations' sake, but largely those businesses that have a growth element whilst they are operating businesses. And we use a number of different transaction structures to make those investments. So P3s, PPPs in the Australian context, or the old PFI type approach, unsolicited proposals where we're bidding largely to governments to tender for the creation, the design, build, operation, finance and maintain of those public assets, typically in the economic and social infrastructure space. We'll invest in development platforms or alongside development partners in platforms as they're growing, and we'll make investments into companies as well, largely with that CapEx spend in the space that we're looking at. We've also got a particular focus in the Americas region on 2 other areas. The first is Latin America. We've got a greater than normal opportunity as infrastructure and development is being built out in the region, and you've heard already today we've got an office opened up in Santiago, people on the ground in Brazil, and activities in Colombia as well. And we also look at some of the adjacencies, so more complex opportunities. Perhaps it might be a take private in the infrastructure or energy space, or something adjacent to those areas of focus that we've got. We've got the flexibility to do that. Typically, we're invested in our assets for around 3 years, but we've got the flexibility to invest and move on earlier or hold for a little bit longer. And the returns on our investments are made through investing earlier at the development and growth cycle, adding value by supporting the development of those assets, and then exiting at a lower return later on to longer term infrastructure style investors of the sort that you heard Plern talking about earlier on today. So this is the business that's allowing us to get exposed to the big infrastructure and energy thematics, but as a principal investor and developer and creating those assets. So we've aligned the business in 2 ways. The first is alongside the big macro themes that you've heard all of us talking about yesterday, today, and you'll hear a little bit more about tomorrow. But we're also benefiting from some particular tailwinds in the Americas as they relate to some particular market features that are beneficial for us as a principal investor in this space. The general market drivers are those you see here: energy transition, of course, digitisation, digital infrastructure, population growth, the demand for those community assets Larry was talking about, urbanisation and the need for government to spend on those assets and services, and private capital availability and its desire to get invested into the infrastructure and energy space, combined with the opportunity to partner that private capital with government and with other industrial firms to make those projects a reality. And we think about that in 3 ways. So the first of those ways is growth. So we're investing in sectors that have growth, and plenty of charts in the last few days to talk about it, but whether you're looking at digital transformation, talking about the spend required to transition our energy sector, the need for capital support that growth is a tailwind for our business. Secondly, the need to spend and government's capacity to spend on the services and the assets that they'd like to. So a lot of our work is with and for governments, those community assets. Governments are spending more or have a desire to spend more, but we're in an environment where a lot of governments are constrained from a balance sheet point of view, and so the opportunity to bring private capital to bear with government to make those projects a reality is part of what we do. The additional thing in this market is it's not just new asset creation. We're in an environment in America in particular where asset renewal is a particular focus. There's a lot of ageing infrastructure both in the transportation and economic sector and in the community sector. So a lot of our P3 type projects are actually asset renewal rather than new build projects. And it's about partnering that capital appetite that we've got from the private capital investor world, dry powder, with the need for those community assets. And so we sit in the middle making those projects a reality. In addition, in the Americas, we are following the same thematic of diving deep with our areas of expertise into the niches that we have that expertise in. And so we're very targeted in the opportunities that we focus on here in the Americas. I compare that to where I've come from in Australia, being a large institution in a smaller market where really the approach was to try to do everything we possibly could in the infrastructure space in the ANZ market. But here we're much more targeted and focusing in on our areas of expertise. We're also able to take advantage of the integrated Macquarie capital. And by that I mean the relationships we've got internally with our industrial groups and with the sponsor coverage groups, where we and the IEC team can be introduced to those partners, those industrial companies, those capital providers, to provide a solution for them on developing and growing those assets that they might not be able to do for themselves. And so we're providing another alternative for them. And as we do that, the thing we're finding, the response from those clients and partners that differentiates us is the ability to bring the capital together with the development expertise. So there's lots of people who want to provide capital into supporting platforms in data centres and energy transition, but we're able to bring the development expertise because of the engineers and developers and technical experts we've got on staff to partner with that. So I'd like to talk about a couple of case studies just to bring it to life for everybody. The first of those case studies is the Pennsylvania Bridges project. This is Sarah Schick's deal, one of the 6 bridges in the first package there you can see on the I-80 up in Pennsylvania. So this is a project that is the rehabilitation of 6 bridges across the state and then maintenance of those bridges under an ongoing concession for future years. We led the consortium with consortium partners Shikun and Banui Concessions, with our builders sitting underneath us through a competitive P3 process. So we won the competitive tender. And the interesting thing about this project, probably 2 interesting things. One is it's procured under what's called a pre-development agreement approach, a PDA, where the state chooses the preferred bidder early in the process as opposed to a fixed price, fixed time sort of tender at the end of a process that you typically see in PPPs. You're chosen early, you work with the state to iterate the design, the evolution of the solution, and then at the end of that pre-development phase, you then provide your fixed price and your fixed bid with the design and build contract sitting underneath that. So it allows for an efficiency from the state and the developer's point of view and really optimising the solution that you're providing in partnership with the state. This one was also financed in the public market, so public activity bonds. It's around about a $2 billion project, $1.8 billion of public bonds raised. We hit financial close in December, and the revenue for this project comes from an availability payment from the state, and so highly geared and a nice one to have in the public markets as well. The second case study I'll talk about is Prime. Prime is a data centre developer, and it's an example of us investing through a strategic partnership. We built a relationship with the founder and owner of the business over about a 6-month period, not a competitive tender process, just relationship building from our part. And that founder and owner owned the business that was looking to develop wholesale data centres and had a platform there and an ambition to grow. When we made our investment in 2021, there were no operational data centres across the platform. There's now 8 fully leased up centres and a pipeline of another 18 that are going to come as we spend our time building out that portfolio as we go. Our investment was through a more structured equity type investment with some protections on the downside, and we've had the ability to put in some debt into the business as well. So an example of a partnership approach into a growing business. Aerogy, Michael mentioned earlier on, is an example of one of our projects in the energy transition sector, more of which you'll hear about from Nick Gohl tomorrow in Houston, who will focus a little bit on this from a MacCap point of view. But it's an example of a platform that we created and founded ourselves. We set up Aerogy to focus on renewable natural gas and put a partial management team in place. And the first project, the anchor project, is a project called Zahn's Farm. So we're taking farm waste, manure and other things, and turning that into renewable natural gas to then sell back into the local gas grid in the community. And so that first project, Zahn's Farm, is now in construction. When it's finished, it'll provide enough natural gas for about 2,000 homes locally in the area. And we're obviously looking to build that platform out now across adjacent farms and adjacent areas in the region. It's another good example also of where the Inflation Reduction Act and other of those tailwinds comes to bear for us. So this project benefits from some of the retooled investment tax credits and clean fuel production credits that come out of the IRA that are beneficial for the project. The last of the projects I'll talk about is Ruta Minera, so an example of a project in Latin America. It's a road from Route 5, one of the north-south routes in Chile, inland to Minera Escondida, which is one of the largest copper mines in the world, majority owned by BHP. And it's a private concession. We won a competitive tender with our consortium, with Macquarie in the lead, with local builders and local Chilean banks as part of the consortium. 137 kilometre road where we are rehabilitating and improving that road as an access road to the mine. About 100 million or so in CapEx, and a really good example of us bringing that expertise into the growing Latin American region, but also partnering with a good client of ours in BHP as well. So look, I hope that gives you an overview for our three principal businesses this morning. And with that, I'll hand back to Michael.
Thank you, John, and thanks to everyone for your attention. Hopefully this gave you a sense for the overall MacCap business and why we're excited to be here and where we see the substantial growth opportunity ahead of us. We're focused on executing our strategy, growing with our clients in those deep areas of specialisation, winning new clients and exploring new adjacencies. We bring Macquarie's balance sheet to bear to capitalise on opportunities that our deep specialisation and relationships uncover. And we do all of this in a culture of collaboration and innovation with our staff out there engaging their networks to find more opportunities for growth. So with that, I'm going to hand back to Sam Dobson for Q&A.
Great. Thanks, Michael. Thanks, everyone, for the presentations. So we've got about 30 minutes for Q&A, and then we'll have Andrew Burdick come up and just talk about the building, and then we'll have a tour and lunch. So I'm going to go to Ed first.
Thank you. A couple of questions. Ed Henning from CLSA. A lot today was talked about the growth opportunity. Can you just touch on the competition you're facing, and are you seeing any fee pressure coming through and also returns on direct investments as the first one?
Sure. Thanks, Ed. So I'd say in each of the businesses we're in, we have different competitors, and it's nothing new. Obviously, Australia's a very competitive market, so we're well accustomed to that. But the competitors that we'd have in something like private credit are very different to the competitors we'd have in a sell-side process, and even across sectors, they'd be quite different. I'd say that if we look at the fee-based business, first of all, we have boutiques, and then we have the bulge bracket. And we're somewhere in the middle because we combine the advice with the balance sheet capabilities. And so we're typically carving a niche out for ourselves there. But we're usually competing with both categories and just trying to come up with something differentiated. From a principal standpoint, there's different pools of capital, but we're typically partnering with someone, whether it's setting up the data centre platform in the case of Prime, or whether it's a corporate looking at how they progress on decarbonisation. And it's a competitive process, but we're typically selected for our skills and capabilities rather than being the lowest price. And because of what Bill was saying before in terms of that funnel, we're self-selecting out a lot of opportunities. So one of the things in our culture that we're very clear on is you've got to be comfortable saying no. There's a lot of opportunity out there, and that's probably the biggest risk, is getting the culture wrong in that regard. So we're seeing lots of opportunities now, just with what's happening in the market, and so I'm quite excited about that.
Okay, so not seeing too much fee pressure even on the advisory side?
No. On the advisory, I don't know if David or Sam, you'd like to add anything?
No, I'd say not at all. I think we're seeing a premium price for the expertise and the domain knowledge in the space, so no pricing pressure at all for us. Okay.
And the other thing I'd add is that often we're trying to align ourselves with our clients and putting ratchets in to make sure we share if our clients are successful as well, and we're very comfortable doing that. We've had some of our best outcomes in that regard.
And then can you just touch on the growth of fee revenue increasing, especially obviously the increasing focus on private credit, and then versus the investment gains coming through the group, so the mix of revenue going forward over the medium term, and how you think about that?
Sure. So typically it's been around half-half in terms of fee revenue and principal returns. And what you've seen due to the strategies that have been outlined is the mix within principal is shifting a bit now because of the growth of private credit. What you'll see is that we've been ramping up private credit, and it's a 3-year product, so you'll see that sort of level out a little bit as we get to scale. And so the mix of the principal income that we're earning is leaning more to private credit over time. But I would say overall we're seeing growth in our principal returns. The fee-based business is obviously depressed this year for reasons everyone in this room knows. But longer term, over the medium term, we see that growing as well, and we're trying to have them somewhat calibrated. And obviously the returns on the fee-based side are very high ROE based returns, so the blend makes a lot of sense from a financial standpoint.
So do you still see it at roughly that 50-50 mix, or because of the growth in private credit, it'll skew more towards?
I think it'll skew a bit more to the principal side as private credit grows and we stabilise, because as we've been growing, we've been also taking on ECL provisions, and that's starting to emerge there. And obviously the equity returns are consistent over time, but they could be lumpy year to year.
And just with the ECL provisions, are you kind of providing up front, so then you've got a balance then going forward, or every time you write a credit, so it kind of offsets the gains initially on the fee side?
Every time we write a credit, we take an upfront ECL provision, and we also, with our fees, we provision our fees and release them over time where we hold to maturity. And so as you're growing, and let's just say that number's 2.5–3%, as you're growing, that can have a depressing effect through effectively a J curve, and then it starts to level out over time as the portfolio reaches maturity.
Okay, that's great. Thank you.
We'll go to Kieran. Thanks.
Thanks, Kieran Chiji Jarden. Couple of questions, maybe just starting, Michael, on some of the newer growth verticals. Looks like sort of healthcare, government services. Just interested in the approach you're taking to building the teams, sort of whether or not sort of you're pursuing larger lift outs, or whether or not it's sort of more organic as you continue to build those verticals.
Thanks, Kieran. It's a very good question. We've tended to grow these new verticals organically with small teams to start. And it seems like teams of 2 is a good recipe as we're starting out. That's just what we found. So in terms of aerospace and government aerospace and government services, it was very much an America's strategy that we've deployed, and we've been able to attract resources from multiple firms. It's a fairly small team, but it's plugged into a broader services group, and then cross-border, then we've looked to add when we have somewhat of a beachhead in a sector. And so as Tom mentioned, that's how we got to know Veritas, which is one of our largest clients, and then we've branched out into the other sectors with Veritas as well. So it's primarily been organic. We made some hires in healthcare services in the past month. Again, an organic lift, but typically smaller teams rather than acquisitions. If we found the right opportunity from an acquisition perspective, we'd consider it. But they're also quite challenging acquisitions to pull off at scale.
And just given the current market backdrop, a bit more volatility, potentially a little bit easier to dislodge some of those staff at the moment. Are you looking to accelerate any growth plans into prospective newer verticals?
We're having a lot of discussions about that. We received decent number of inbounds, which we obviously consider. What's most important for us is the actual making sure the sector is a sector we believe we can win in. So we get approached often by sectors that the team may even be appealing, but we just don't think we have what it takes to win. We often look through a sponsor lens when we look at that and we talk to our clients. Helpfully, our clients send us people, which is always a good reference. And then, of course, we look at the fit of the individuals, which any employer could say, but it's really important from our perspective, given that the collaboration is so important. You get the wrong team or individual in the group, and it can be quite unhelpful.
Thanks. And just a second question on sort of the private credit opportunity. Obviously, a very large market growing quickly. Can't remember the exact number. I think it was a bit shy of $1 trillion. But just interested, given you've got very specific niche focus within that, how much of that market is really available or open to you currently? And also interested how you're thinking about prospective IRRs in the current interest rate backdrop.
Yeah, sure. Two very good questions. So clearly we're looking at a subset, and then within that, back to the funnel that Bill talked about before. That growth has come from us being highly selective. So we don't feel like the addressable market is an issue for us. We tend to focus on the technology-enabled sectors, such as software and insurance broking, or education services, healthcare. And those sectors happen to be the ones that financial sponsors focus on as well. They're typically looking for growing services revenues, and so the alignment's pretty good. What we don't do as much of is industrials. We don't have a lot of energy input exposure, resource input exposure in our portfolio, but it's a large addressable market, and we're not really looking to expand it. We're very focused on that capital preservation point. So we're comfortable if we had some concentration in insurance broking and looking for diversity geographically or within the segments within insurance broking, which I won't go through, but there are many of them. And then addressing your second question, Kieran, on pricing, obviously we've seen base rates go up a lot, and so whether it's SOFR or any other base rate, we're talking about going up from up to 4 or 5% in some markets. That's being passed on to the end borrower. We, within our own business, have a very disciplined approach to pricing risk. So Treasury passes on pricing on a fairly dynamic basis to us. Some competitors may price their liabilities on a fixed basis and then wait for a refinancing. We look at it on an ongoing basis, and so we absorb that higher financing cost. What that means for us is that it ensures we apply the discipline on our spread in engaging with the market. It also has meant that over the past few months, as rates have been going up, we've slowed our deployment down a bit whilst the private markets have been catching up in terms of rates. So as Larry mentioned before, private markets tend to lag the public markets, and we can see that through our networks, and we're patient. But in terms of the volumes, given the public markets have been fairly anemic, we've seen a lot of demand in private markets even at those elevated rates.
Thanks.
Andrew Lyons. Thanks, Andrew Lyons from Goldman's. Michael, in response to Kieran's question, you've answered, I guess, the strategy on your inorganic talent acquisition, but I'd be keen to sort of understand a bit more about the strategy of organic talent acquisition, particularly as the brand has grown in the North American market and the opportunity that's provided to sort of, I guess, build out the business organically.
Sure. Well, maybe I'll pass that one over to David or Sam to talk about, just because they're actively in the markets and
Absolutely. I think that it's a great combination of inorganic and organic. Michael talked about the difficulties of acquiring an entire organization because the assets are the people, and that has challenges associated with it. I think the inorganic hires, important to find the people with the right skill set, the right focus on an advisory-led practice, but importantly, the right culture that fits into the organization. The best part about organic development, which is where we're really focused, is those people have been born and bred into the Macquarie culture and have grown through the organization. So a lot of time and effort spent on developing those junior resources, and they're actually, we find them to be the most productive people in helping us find those new niches, go explore territories that we haven't trafficked before, and that actually has been very helpful in growing that business. But it's got to be a combination of the two, all in line with fitting with the culture.
And maybe just, I don't know, Sam, if you want to add some of the verticals you've been recruiting in software recently, just to give a sense.
Yeah, to continue on David's point, we have expanded in select verticals within vertical software. So areas like supply chain management, customer experience management, to name a few. I think one other element that's helped us on the organic talent acquisition is actually the product portfolio, because we do frankly get inbound talent that is focused on platforms that allow us to combine advisory and principal, and so that product portfolio element, the way that we approach the market, especially in the mid-market, is a pretty big differentiator, and by virtue of that, we've been able to get some pretty good inbound, on new talent.
Thanks. That answers the question.
Andrew Triggs. Thanks, Sam. Andrew Triggs from JP Morgan. Just some of the numbers you provided today, which are really helpful, suggest a strong sort of overweight position in the financial sponsors market. So 2/3 of deals year to date have been involved with a financial sponsor versus 30% of the fee pool for the market more broadly over a different period of time. But that's obviously been a big tailwind over recent years, given the build out of that market and the interest rate environment. Will that turn into a headwind going forward? What are your observations on deals that require leverage to get done at the present moment? Are there any green shoots on that front as well?
Yeah. Thanks, Andrew. It's a good question. So we've all seen the resetting in terms of rates, and that obviously does play through to leverage levels. And so we're going to see winners and losers in that as a consequence of that. I don't see it as a headwind. I do see somewhat of a delay possibly in terms of until the markets return to, we see some end to the rate increases and give our clients an ability to actually price risk themselves. We'll see a delay in M&A activity. We're starting to see green shoots. I was in Europe last week. We're starting to see more public to privates emerging. We're seeing more deal screens in our leverage finance business in the US, and we're seeing, like on the M&A front, we've got as many sell sides as we've had ever. The problem is, which you bring up, Andrew, is there's got to be a valuation reconciliation between the buyers and sellers, and sometimes you only find that once you've launched a process, and so some people are reticent to launch until they know that they're going to have some success. For us, that's sort of a timing delay. The interesting part for us is, given our capabilities and what we can do, it actually presents some opportunity on the principal side as well, which increases the dialogue that we're having. So I'm not sure, Tom or Bill, if you'd like to add anything to that from your perspective. Okay.
Yeah, so is it really just a cyclical slowdown and probably return to a structural tailwind, that sort of position?
I believe that the tailwind will continue in private capital. I think the other thing that we're seeing more actively in terms of our book is add-on activity to existing companies is actually quite high. So if you've got an existing platform, what we're seeing is more combinations to find a way maybe out of some of the inflation pressures that these companies are experiencing. So I think it'll be a delay. I think this is a long-term secular trend on private capital, and as you would have heard yesterday from Ben, the demand for alternatives is very high, and that flows through to the transaction activity.
And the financial sponsor market is often viewed as sort of generic or relying on heavy amounts of leverage. Is that fair, or what portion of the activity pool in the private equity market actually isn't truly reliant on lots of debt to get acquisitions done?
Well, we're seeing actually the private credit market more broadly is actually growing quite fast outside of private equity as well, whether it be private credit or infrastructure or real estate. So in private equity itself, we're seeing some other strategies emerge. We are seeing long-term private equity funds emerging that may have lower leverage. The Core Plus that we're talking about, that's sort of halfway between infrastructure and private equity is another one. But to make these businesses, the economics work for private equity, they typically need some degree of leverage. What you are seeing to get a good deal done is people may go with less leverage to start and then refinance down the track. And so you're seeing that in the private credit market at the moment, some big private credit deals being done. They're all repayable, they're all at some point. And so when the syndicated markets return, even if they're lower leverage, the sponsor may be forming a view that down the track things will, they'll maybe have a dividend recap down the track. I would say leverage all though has been coming down, both because it needs to, the market's not there to support it, and to get deals done in this market, there's no other way to do it rather than over-equitise.
Right, I'll start with John Mott, and we'll go up to you, John.
Thanks, John Mott here from Barrenjoey. A couple of questions, and we'll continue on the theme of the private credit and private equity. If you look at it, there's 70 positions. I just wanted to get a feel how many of those 70 actually are related to private equity businesses or sponsors, if you want to call it, that you have that relationship. Bill, you can probably take this one as well. And also, do you ever have two positions in the capital stack where you'll have a private credit position at the same time you'll be somewhere else in the capital stack, maybe with an equity investment?
Bill, are you happy to answer it directly?
Yep. So over 90% of our portfolio is tied to a private equity sponsor. So it's in the 60s. And then as to the second question, the answer is yes. I would say that is not the norm. In terms of the, call it 70 transactions, it's definitely single digits as to where we would have multiple securities, whether that's, senior debt. It could be, call it some type of junior capital. But as you heard, the vast 90%, more than 90% of the global portfolio is structured senior secured debt. But we do have on occasion a piece of some type of junior capital. And on one or two occasions, we have that in an existing investment or also in the senior debt. We also then, as to the equity, will have some, whether it's smaller co-invest or minority equity. But again, in aggregate, it's a single digit number relative to the 70 positions.
Yeah, but it's certainly something we look to if the client's looking for it. So we've had numerous examples where clients have asked us if we'd be aligned with them, particularly in some of the roll-up strategies, because they like the fact that we're directly aligned.
And just a follow-on question, might as well keep going on it. With the spread, I think you mentioned the NIM you're making on it's 4.5% to 5%. Add the benchmark in, you're probably charging customers upwards of 9 to 10% is the rate they'll be paying if it's floating at the moment. How are they performing on interest coverage ratio, especially if you're highly leveraged? There could be a few businesses which are pushing up against potential covenants. How are they performing if rates stay higher for longer?
So far, the portfolio is in very good shape overall. There's always some whether in any market, there's idiosyncratic situations, that vary from underwriting, but overall the book is performing very well. Part of that, and I'll get to your interest coverage point specifically in 1 second, I'd say you heard the sectors that we invest in. Many of those sectors, if not all of those sectors, have pricing power. So that's translating into overall EBITDA cash flow growth across each individual borrower, which is helping reduce that metric as time passes. Nonetheless, to your point, at the time we underwrote these deals over the past couple of years when base rates were sub 50 basis points, now you're at 400 basis points higher. That has compressed the coverage ratios. So it's not what we originally, on a pro forma metric basis, there is less cushion, but by and large, the portfolio is doing well. The businesses are performing well. And so long as that continues, despite there being less cushion, there's still covenant, there's still headroom cushion between the covenant levels and what we think is adequate. So we feel like we're in a overall good spot.
Bill, the only other thing I'd add, John, is is often these platforms are set up for acquisition, so they may have some sort of delayed draw facility alongside it to acquire assets. That's often an opportunity for them to over-equitise if they're getting nearer to covenants as well. So there's usually, often sponsors may want to debt fund a lot of the growth, but they're increasingly probably putting in some equity, which is a combination of funding acquisitions, and if they are in need of some headroom, they can put in equity as well. The quality of the businesses and the fundamental underlying businesses is what's most critical.
Go to John Story at the back there, Alex. Thanks.
Thanks. Michael, just a question on the actual business model around principal investments. You've seen a lot of other global investment banks actually pull back from principal investments, just given the fact that it's quite capital consumptive and the RWA densities around it are quite high. Maybe you can just talk to why you still see it as quite attractive in the economics of your model relative to other global IBs, particularly with that capital drag. And then just the second question I have is, how do you value the assets? How are the principal assets valued? How do we get visibility around what the unrealized value and potential gains looks like on them?
So I can't really speak to strategy, and I might pass some of the last question on to Alex as well. But when you look at our strategies, and we went through each of them, whether it's infrastructure development, whether it's the private credit business, whether it's our private equity, we have focused on underlying cash flows in our business. So we did not get heavily involved in the hypergrowth technology space that, as an example, in terms of a strategy, we've tended to focus on businesses that have these secular growth themes supporting them and typically have underlying cash flows emerging. So in terms of the valuation sensitivity, I think we're very careful about that. We look at risk-adjusted returns, and we're not just looking to deploy for the sake of it. In terms of the capital intensity of the business, we are usually holding these investments for 2 to 3 years and looking at a recycling event during that period. And I would say particularly when you look at it on a standalone basis, if we're producing 20% IRRs, it's a very accretive activity. So our performance is what's most important, combined with the fact that we're earning income elsewhere in the business attached to these activities that is quite capital light, gives us good returns. I can't really comment on the competitor strategies and why they may be moving to different models, but I feel the returns that we're earning, whether it be out of private credit, as we've spoken about, or the strategies around equity, are delivering very attractive returns for shareholders. From a valuation standpoint, I can tell you from the disciplines that we have within the group, it's not just a risk process. There's the financial management group works hand in hand with us. Each of the investments, if they're marked to market, we're marking them to market. If they're equity accounted, they're equity accounted. We go through a very disciplined quarterly portfolio review. So we have individuals who are accountable and responsible for their portfolios, whether it be Bill or Larry or Florian for Principal Finance overall. And they're day in, day out working on these positions. But we have quarterly portfolio reviews where both our risk management and finance teams are involved. And so it's a very active dialogue in terms of the book. Alex, I'm not sure whether you'd add anything in terms of valuation of the book.
Yeah, thanks, Silver. I mean, most of the book is at amortised cost under the accounting standards, whether it be the debt book, the private credit book, largely at amortised cost, or most of the equity books at amortised cost until we realise it. Most of the equity positions are at amortised cost because we tend to have significant influence or control. Obviously, if you've got a smaller equity interest, then it's mark to market, but that tends to be a smaller portion of the overall book. As Michael said, I mean, every half we obviously go through an exercise of actually looking at the carrying value of those assets and making sure we feel like the future cash flows support that carrying value, whether it be on the debt side or on the equity side. And just to reinforce the point that Michael made, I mean, obviously well, both on the private credit side, if you look at the historical IRRs that we're delivering on the private credit side, we feel like the book is performing well. The margin we're getting on that sort of 4.5%, 5% over cost of funds, so you can get a sense of the repeatability of that income. And in terms of the equity book, I think, Michael, your slide talked about 20 years of history at sort of 24% IRR, I think, over the course of time. That's obviously no indication necessarily of the future, but plainly, the successful track record of investing in equities produce those sort of returns. So that'll emerge over time. As the book gets bigger and you think of it as a portfolio, then you'll see more regularity of that. But plainly, from one period to the next, you'll see some periodicity just based on where there's a realisation that comes through on that period versus the next.
Go to Brendan down the front first. Then
It's Brendan Sprouse from Citi. Just again, a couple of questions on the private credit opportunity. How long do you expect the opportunity for these sort of levels of flows to continue? It does look like there's quite a bit of dislocation for debt markets. Obviously, the banks are struggling with deposit growth, particularly as QE unwinds. Is this something that's a couple of year type opportunity, history would say, and then it will slow down, do you think?
I think it's a longer term opportunity, and I think it may bleed into other areas as well. So, we're primarily focused on the sponsor LBO space, but I could see this starting to emerge in small to mid-market corporates in the US as well, as an example. We're also seeing continental Europe pick up in terms of demand, where typically it's been a bank market. Private credit is emerging as a real opportunity there. So recently we've seen some growth in that regard. Also, like Mam spoke about yesterday, the private credit opportunity around infrastructure and around more investment grade exposures as well is a big one. So I think this is a longer term trend. I don't know, Bill or Tom, whether you'd like to add anything. And Bill, you may want to stand up when you talk.
Just to address, it's been a long-term trend for the last decade, and I agree with what Michael said, that it will continue. You mentioned the dislocation of the debt markets over the last 9 months. The private credit market has also experienced that dislocation in the sense that there's been much fewer transactions out there. M&A volume does impact the volume of my market as well. And so the market share has very much shifted. The 30% I referenced over the last 6 to 9 months is dramatically higher, but the overall volume is so much lower, there's fewer deals. So even when the market shifts back to more normalized levels and there's going to be more syndicated deals, there is, I think, this continued secular shift that's happened. And that's evidence in the book on the chart we had, where the portfolio in the Americas for the last couple quarters has more flatlined, which is twofold. One, it's less M&A activity, so there's less opportunities. And it's, as we talked about, it's all about that funnel. So you need the opportunities in order to pick the right deals. And two, it's been a conscious choice by our team as we wait for it was referenced, the market lags a little bit. We've waited for the pricing, which we've seen now, to back up. There's better opportunities out there from a risk perspective, or from a return perspective. So it's a combination of those two factors, which has resulted in sort of our I'd say call it slowdown over the last few months. It was partially intentional.
Yeah. And it feeds back to the dry powder as well. We still have the dry powder in the equity funds that will be deployed, and I think a lot more use of private credit.
Just a sort of follow-on question from that. To what extent is scale important here in private credit? I mean, banks traditionally have probably serviced these customers over time, and they've always used their benefit of scale, like the one with the cheapest cost of funds or the largest operations and the best expertise tend to have won across most markets. What's different here that scale isn't such a big driver?
I think it's more event-driven. So when you think about what we're doing, it's either an M&A transaction or it's a platform that's growing where we're doing add-ons, and so we're doing something else at the point that we're engaging and providing balance sheet. So I think because it's driven by an event and we're involved in that, it puts us, as I think Bill said before, it puts us in a position where we're getting an earlier call. So scale, this is not a scale game for us. I mean, if we weren't seeing the returns, we would scale it back and we would divert capital to another activity, whether it be a different segment of private credit or to equity. and that's something that we've seen an opportunity in private credit that we've been pursuing, and so.
Go to Brian Johnson, just towards the back.
Brian Johnson, Jefferies, thank you very much. Just three lightning quick ones, if I may.
Sure, Brian.
If we have a look at Macquarie at the group level, the ECL provisioning is still really, really strong. When we have a look at what's actually happened in the economy, we've gone from the fear of COVID to basically a boom, and the outlook is probably somewhat uncertain. Just within the Americas business, is the ECL provisioning still as strong in your business, or is it Alex tops it up at the group level? So has it gone down in the US business, but Alex is keeping it there, or is it still strong in your business?
Alex, I don't know if you'd prefer to answer
That's
that one.
fine. Hi, Brian. Thanks for the question. Yeah, just to maybe just go back around to the point you just made. So a couple of years ago when COVID came in, we basically put an overlay in for COVID for additional provisions that we thought would come through as a result of COVID. Over the course of the last couple of years, obviously we didn't see the defaults coming through from COVID because of the government stimulus coming through and the accommodatory monetary policy. But we, as interest rates have stepped up, we put an overlay on the ECL models that's now passed out to the group. So there's very little sitting centrally. So in terms of the MacCap business, if you look at the overall ECL for our credit book, I think the book's about 16.7 billion, something like that. We're holding about $600 odd million, $650 odd million worth of provisions against that credit book, and they're basically sitting in Macquarie Capital's business. That includes partly an overlay. That overlay exists because you've obviously had a very steep increase in interest rates that's not predicted by the models, and most models around the world would have the same sort of overlays that, or the need for the overlays that we're seeing. But it's basically sitting in the groups rather than centrally.
The second one, if I may, which I suspect Alex will end up answering anyway. When we have a look at Macquarie, it ain't a bank, it's a non-operating holding company. So we've got a bank down the bottom, we've got a non-bank. This private credit business, it doesn't sit in the bank, is that right, Alex?
Yeah, that's right.
So how much capital do you assume is put away for the private credit business? How much equity? And the actual transfer pricing of the debt. So if I get a feeling on the equity that backs it, how much debt there is and how you actually price it around, because it's great to talk about the cash rate, but your cost of funds is not the cash rate.
So we obviously raise funds through both the group and the bank. In terms of businesses that sit in the non-bank, there's a non-bank transfer pricing rate. It's obviously different to the transfer pricing rate that sits in the bank businesses. And that makes sense. Obviously, we're trying to align the risk profile of the non-bank businesses with the non-bank funding profile. So we separately TP out of both the bank and the non-bank. And so, as Michael said during the presentation, or it was either Michael or maybe it was Bill, I don't know, but what we saw over the course of the last 12 months is our own cost of funding going up. That was reflected in the marginal transfer pricing that we're passing to Michael's business in the non-bank. And it took a while before that increased investment grade pricing moved its way into the private credit markets. And that was one of the reasons that the team, I think, in a really disciplined way, saw a slowdown in growth in the private credit book. So hopefully that answers your question. Non-bank transfer pricing to non-bank businesses, bank transfer pricing to bank businesses. I think the second question was capital, was it? In terms of
how much equity is there supporting that book?
How much capital is behind the book?
Yeah.
Well, we obviously, the capital model that we use for the non-bank businesses is the economic capital adequacy model. So it's based on similar principles to the bank capital regime that you're familiar with Basel. Obviously, it's a model that we've had in place for a long time, Brian, that's been approved by APRA. And what it's trying to do is basically replicate the amount of capital you need to basically assure yourself against a 99% chance of default. So that's the sort of capital regime that sits behind the non-bank capital book, whether it be the debt or the equity sitting behind our non-bank businesses.
And just
we don't specifically release the capital behind the private credit book as opposed to anything else. But the model obviously in the documents that we release, both for Pillar 3 and also in our half year and full year results, you can see the basis upon which we hold capital against non-bank businesses.
And the final one, Alex, is you equity account the investments, most of them. So I'm just interested, if we have a look at what's happened in equity markets, no profit tech has been smoked. Just if you equity account it would suggest that you're always writing down the carrying value. Can you just confirm the appetite that we've seen in the equity book for the loss-making tech and the valuations of those, how that's been impacted by equity accounting?
Yep. Well, I'll have a go, and then Michael can answer. It's obviously a business question here in terms of the appetite. I mean, a lot of the tech businesses, as I think Bill talked about and Larry talked about in his section anyway, are not early stage tech businesses. So they're businesses with recurring revenue, typically, software as a service type activity, providing essential services to, governments and others. So it's not necessarily the case that those businesses will be generating losses, and so the equity accounting losses may or may not be there. Obviously, some of the early stage stuff does have losses, and we've got some appetite for that. In relation to the, I'll pass on to Michael in a second to talk about it from a business viewpoint. In relation to the carrying value of those assets, as you said, most of our investments are equity accounted, and so you're basically impairing the value and use with the carrying value of the asset on the balance sheet. And obviously, we go through that exercise every 6 months, and if that VIU, value and uses, come down, then we'll take an impairment. But generally speaking, the assets that the team's investing in are relatively defensive assets, which have performed well over the course of time. Michael?
Yeah, thanks, Alex. Brian, I think by example would be the best way to illustrate this. In the US, we've been mainly focused in tech-enabled companies. So Dovel was one that we profiled in there that we didn't talk about. Larry may want to talk about that briefly. We do have a small venture capital portfolio we didn't talk about today. Its focus has been more geographically Australia, Israel, and parts of continental Europe. Those check sizes are typically quite small, and so in terms of the impact on the overall portfolio and P&L, they're fairly muted, and we're getting in at an early stage where we haven't got caught up in the late stage 10 times revenue acquisitions. Dovel, Larry, do you want to just briefly talk about the Dovel situation very briefly in terms of it was tech enabled?
Yeah, just by way of accounting on that one, this was an investment we made in government services, IT, in the healthcare sector in 2019. It looked at about 80 companies and wound up with this one, added in another entity called Ace Info. Both of these were done at a reasonable EBITDA multiple. They were done at about 10 or 11 times EBITDA. I think on pro forma was sub 8. So from an equity accounting basis, we really weren't taking much of a hit. It was lightly levered. We did a lot of work on that thing. Obviously, we were able to grow revenue almost 300% on that, and it was EBITDA improved alongside that. It was a great sale to Guidehouse at the end of the day, which is again a big client of Macquarie, and so if you look at that versus something like a Payit, where it's held available to sale, that's a structured equity deal with good downside protection. So that's, I think, from where we're carrying things from the mark, everything's attached to the fundamentals versus sort of a momentum or relative revenue valuation. So I think that's where you can get some comfort.
Brian, does that answer the question? Yeah.
Running a bit over time, we've got 2 more questions. So Andre first, and then Catherine, and then we'll wrap up.
Morning, Andre from Morgan Stanley. Just want to ask one question, but perhaps 2 parts to it. So that's slide 11 that shows the 24% equity internal rate of return over time. It was substantially boosted, it seems, in the last 2 years, and it looks like the Green Investment Group was included within those returns. Yeah. So what would those returns have looked like without the Green Investment Group?
Yep.
And then going forward, now that the GIG has shifted another division, how much opportunity do you see, for Macquarie Capital to continue to make investments into early stage transition work?
Yeah, sure. Thanks, Andre. So a couple of things. We didn't put it on the slide, but the return excluding GIG is above 20%, so it's close to the 24. It's a little lower. So, but over the 21 years, it's not driven by solely by GIG, although they've been at a similar return level. In terms of the last 2 years on that page, it spikes, and the reason for that, it's a vintage. So the last year are only the realised IRRs that we made in that vintage, which means we held them for less than a year. So the IRRs by their nature are higher. That doesn't kick up over the averaging period, the IRR, by much either. I think less than 1% or something. But that's why it steepens, because we sold a couple of assets within that 1 year period, and it will level out. We continue to see a lot of opportunity in terms of emerging technologies, whether it be in the sectors we've talked about today or around decarbonisation and the energy transition. Our focus is different to GIG. We've made certain investments. Early stage, we invested in a company called Form, which is focused on long duration storage, which we're quite excited about. We got to that opportunity through another transaction that we were involved with, which is a great way that we source opportunities. When a CEO recommends us to another CEO that they think highly of, that's how we've got involved. So we see the actual enabling technologies around decarbonisation as an attractive area. But it's one of many strategies that we're looking at around technology. Larry, is there anything you'd add on that one? No.
And then Catherine?
I just had a question back on private credit again, just trying to get some comfort. Because the book was only 14 years old and you said the average loan loss was like 0.3%. Just trying to understand what the expected long run loss would be, given you really haven't seen a cycle and you've had a period of very low rates in that book, and given the margin's 4.5, 5, I'd imagine the actual expected long run loss rate would be much higher than 0.3.
Yeah, I think we have seen, COVID was a pretty big event for the portfolio to endure, and we saw it perform well. 0.3% is our average. We've really only had losses of significance in 2 positions, I think, over the period. All we think about is the capital preservation and downside protection. I would say there will be times that we have to follow our own capital into these names to protect them. We're taking risk. We're not earning the risk-free rate. We're getting a spread to risk-free. I see that as an advantage relative to many of the people who are in the names with us, because if you consider what we can do versus maybe a traditional private credit fund that may have a limited life and not be able to follow its names, we have an opportunity to support the company and potentially reprice those names. I think the provisions that we carry through the ECL are appropriate for the portfolio risk, and obviously well below the historical loss rate. I don't know, Bill, given your long experience, even in your predecessor firms, whether you want to add anything to answer Catherine's question?
Yeah, maybe just to illustrate it with an example, just from the GFC perspective. During the GFC, and this data's out there, the high yield in the U.S., the high yield index lost 6.6% of realized loss. The leveraged loan index lost 4.9%. Now that's the broader market across all sectors. We've taken our portfolio, overlaid loss rate by sector today as the portfolio sits, and that would translate into 2.5%. Now, but on top of that, we've talked about the funnel. We're turning down 95% of deals as opposed to what gets pushed out, or what is out in the broadly syndicated markets, either market. So given the credit selection criteria that we apply, we would like to think, and all the things that Michael just mentioned, that's going to, we're going to continue to perform much better than market.
Great. Thanks for all the questions, all the interest. I'll ask Andrew to come up. Thanks, Silva.
Thank you. Thank you, everyone.
Andrew's just going to give us a very brief overview of the design of the building, and then we'll go on a tour and have lunch. Thanks very much.
Thank you, Sam. And it's great to see everyone again today. Is this the... Sorry, guys. Perfect. I hope everyone enjoyed the tour in Philadelphia yesterday, and I hope you guys get a sense today of what we're going to be able to do here at 665th. Just a couple key points about the project and what's really the design drivers around it, and then we'll break into two groups to take some tours of the facility. Like all of our projects around the globe, at the end of the day, our workplaces are here to support our people, to underpin our purpose, and that is to empower our people to innovate and invest for a better future. Now, as I mentioned yesterday, the process that we follow is just as important as that final product, and that's really around starting with a human-centered design process that listens to our people, incorporates as much data in that process as possible. We're looking day to day as to how our people are using our existing facilities, how we can learn from what we're doing today to make as efficient and as impactful a project here as possible for our people. And that's really with an eye on two things. Looking to the long-term flexibility of this facility, our businesses continue to grow and evolve with time, and we want to make sure that our workplace truly is in support of that. And then last, this notion of a focus on sustainability and wellness is crucial to every single workplace that we build, but it was particularly important in the selection of this facility here at 665th. So I think we started with about 140 sites that we were looking at around Manhattan about 18 months ago when we started this process. And one of the things that really drove us to looking at this facility was twofold. So when Brookfield took over this property, they stripped the whole thing down to its base structure. So this is basically a new facility, but utilizing the embedded carbon of the old structure, an old 1957 structure. So Michael Silverton mentioned the windows. They're probably the most visible part of this building, but they represent an incredible rehab, incredible repositioning of this entire building. They're 11 feet by 19 feet, as was mentioned before, some of the largest that you'll see. And what they really are about is getting as much light and air into this building as possible. And as you can also see in this image, this building also is providing us a huge opportunity to access outdoor space in almost every part of our daily rituals in the work life of our staff. So as you can see here, we're going to be on levels 10 through 16. The area is highlighted in the blue line there, right at the sort of wedding cake stack of this building. Gives us a great prominent stature in the building, but what it really does is gives us 5 out of the 7 terraces that this building provides. Those 5 terraces will be dedicated solely to our Macquarie staff and guests and are a huge differentiator, particularly here in Midtown Manhattan. 2 other differentiators for the building. One, we will have, though it's not built yet, we will have a dedicated lobby on 52nd Street. That allows us to curate that guest and staff experience from the curb to the elevator to the tower, much like we've become accustomed in Sydney, in London, and now in Philadelphia. So really excited about what that means, as well as in terms of our street presence, signage visible at the street. Which brings me to the third point. Michael also mentioned the sky signage, and I just want to impress upon how rare that is, frankly, in Manhattan. So we're incredibly excited that those are already up on the building. That was to meet our grandfathering clause in the zoning, but they're already up, and what that allows us to do is to reach over 150,000 individual views every day. That's the clock number that you can see of individual views each day. As I mentioned, incredibly rare. There's only a handful, a few dozen of these buildings left grandfathered into the zoning in Manhattan that allows us to have a corporate sign at the top of the building. And so for me, as I mentioned the story yesterday in Philadelphia, the day that we lit that sign, people were starting to Google Macquarie. They were mispronouncing it, but that's okay. But they were Googling it. And with 150,000 views a day, I think it's an incredible moment for us as we build our brand here in my hometown in New York. Just a couple points on the design. So obviously we are building upon an incredible legacy of spaces around the globe. So as an architect that was based in New York, I actually knew about Macquarie long before I knew what Macquarie did. These images were on the top of Pinterest pages and design groups for years. And what was driving me to them is how much they had in common with all of the civic spaces and libraries and great collaborative spaces that I had been working on in my past life before joining Macquarie, and how vital and timeless they are in terms of creating an incredible brand and an impact on our people. But what do they have in common? They emphasize connectivity, visual and physical connection between our businesses. They support a unified and curated approach to an immersive identity of experience for our staff and clients. They maximize access to natural light and air, just getting the basics right. Most of our facilities now have direct access to outdoor space on a day-to-day basis. And then last, each of them are really focused on an efficiency and an openness of flexible floor plates. Again, getting the basics right, but really celebrating those values in each of these buildings. And so as we got into this design, the key question was, how are we going to build upon that legacy? Not copy it, but build upon it. And how are we going to do that in a center core building, an American typology, frankly, here in Midtown Manhattan? And so if you think of Shelley Street, it's this incredible canyon of space that ties horizontally and vertically through the building. If you think of 50MP, it's this very pure, singular space, 11 stories that connects all of our businesses together with these wonderful elevators paralleling it. London, we built upon that, and then we activated that hole in the middle of the building with all of our stairs and our meeting rooms hanging out over that space. What are we going to do for New York? Well, imagine if you took Ropemaker, this incredibly activated vertical, this machine for business, and you stretched it diagonally across a building. That's what's creating what we're terming the Avenue for our New York facility. That's going to connect us at the east end of level 10 all the way up to the west end of level 16. Give everyone equitable access to all of those outdoor spaces that I was just talking about, and really giving us a slice of the business as you walk up and down through this space. In many ways, you can see the gridded quality of this building. It's like a Tetris model that we've played with and slowly eroded all the way up through the building. So we think that this is going to be a really great addition to that Macquarie space, that story of the spaces that connect us together. But really creates a sense of inclusivity. Rather than just a vertical space, you really are going to activate that space with us along it throughout each day. Now, what our tour today is going to have, we're going to go up to level 15, our top terrace floor. We're going to stop on 13, then 11, 10, and come back here. But in addition to the tour that we did yesterday, we also have, just behind that wall there, some of my colleagues from our consultant group, A+I, Architecture Plus Information, have a VR setup over there, as well as our material palettes and things. So we really hope that this gives you guys an opportunity to play around with some of our tools, have some fun with it, somebody put the goggles on, et cetera. And as we walk the tour, we also have a number of stills and snapshots of the key renderings. And just for what it's worth, these are fresh off the press. We are looking to share them with staff again soon in the next few weeks. So this is the space that we're envisioning. We're going to be basically walking along that path, although the holes don't exist yet. So everyone will have to put sort of their VR goggles on in their head. We're going to walk floor to floor there and get a sense of what that's going to feel like in the future. So what we're going to do, since we're using elevators here, we're just going to split the room. We're going to have group 1 and group 2. So group 1, you're going to come with me first. We're going to go to the elevators. We'll head up to level 15 and work our way down. Group 2, Ellen, I believe lunch is getting set up. Lunch is going to be on this floor, as well as I invite you over behind that wall to join some of our team members and kick the tires on the VR. And we'll take your questions throughout and focus most of the tour on what you guys want to hear about the building.